it in any group of people, more than two, which is you're going to have opinion. When people have can have voice to their opinion and are amplified by our internet communications miasma throughout the world, you're going to get a lot. I mean, go on Slack or go on any channel of your own colleagues, give them anonymous voice. They're going to say terrible things about you. Not all of them, but some of them will. Get used to it.
Barry, Dara Khosrowshahi was your CEO at Expedia for many years. Why do you think he struggled at Uber?
My God, how could he not struggle at Uber? Give that little operation to anybody at the time he got it. I think he's done a fantastic job. Dara came in and changed the culture of that company with great speed and determination. He was on his way towards profitability. He was, I think, going to break even in the fourth quarter, which was a tremendous achievement. I don't know, the struggle of Uber has been a struggle of resurrection from what is a fantastic base business. They built up under Dara, they built up their Uber Eats business, which is a leader and will be a leader in the future. So good marks for Mr. Khosrowshahi. I mean, don't judge him on the market, on taking the company public and having it get, crashed because of all sorts of other things. Just judge him on the enduring value of the company he's building.
You once told me you'd never sold a share except to pay taxes. And I presume, given what I've seen, that's still true. And you're nodding your head, so I take it is. Barry, Bloomberg estimates your wealth at something north of $5 billion. What's the long-term plan for that money?
Topic of conversation within my family. It's in several parts. It certainly is in philanthropy. I have not ever agreed with people I greatly respect, Mr. Buffett and Mr. Gates, that you should not pass on wealth because it has deleterious effects on all sorts of things in ambition. I have another standard, which is you really should understand the character of those you are bequeathing wealth to. And if you feel they are of good character and responsible, then I have not only know, I feel there's nothing wrong and there's some right in passing on wealth. I don't think, again, if you know who you're giving it to and what their character is, you can make judgments. I do not think the giving or not giving of wealth has anything particularly to do, again, to the individual with ambition. And there are examples all over the place, good and bad in this. But I think you have a responsibility, as our family has, for certainly giving over half of our wealth philanthropically. And it gets complicated when you're dealing with the unborn, which in today's world, when you deal with these matters, actually you're kind of forced to do. It's not without its complications, but that's the best answer I can give you.
Barry, you told me in 2017 about meeting Mike Pompeo, who was then director of the CIA, at the Allen and Company conference in Sun Valley. And at the time you said Pompeo's decency and his grasp of issues made you feel better about the Trump administration. In fact, The words you used were you felt you were in good hands. We've got a few months left of the Trump administration, at least into the election, and then we'll see what happens. How do you feel right now?
I've been disappointed. Listen, I can't help but be disappointed by anybody in this administration other than the Treasury Secretary, who I think has done a very, very good job. And I'm sure there are other people who've done some good work. But this is a terrible administration. And I suspect the closer you are to the president, the more harshly, again, with the exception to at least my knowledge of Mnuchin, the more harshly you should be judged. And I'm just hopeful that my worry is, I think if the election were held today, according to polls, et cetera, I think we would have a change. I'm frightened that something will come between now and November that might change that. Nothing could be more important than changing this administration.
Why?
Because how do I do this quickly? Because it is rotten at the top. And I can't go much on with, if you don't know that, you're not sentient. So what is the point of saying it? It is rotten at the top. And when you have a situation like that, you know, we've had good presidents, bad presidents. We never had a rotten president. We now have one, and he should be gone.
Well, we have between now and November to see how it plays out. Barry, I want to thank you very much for taking this time to talk to me.
Nice to be with you.
That wraps up my exclusive front row interview with Barry Diller. Stay tuned to Bloomberg Television and Bloomberg Radio, and visit Bloomberg.com for all the latest news and analysis 24 hours a day. Stay safe, everyone. I'm Eric Schatzker. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
So when did the brilliant idea come to you to set up a brokerage firm?
Brokerage was built upon how well companies could make money and not how customers really wanted to do business.
Your ads in your company for many, many years have featured your face.
My director of our advertising said, "Why don't we use your picture sometime?" I said, "Are you kidding me?" We tried one. The results were up by tenfold.
Do you have any stock tips for me? I'd look for a couple stock tips. Do you have any good ideas of what I could do with my money in the stock market?
How about an index fund?
Would you fix your tie, please?
Well, people wouldn't recognize me if my tie was fixed, but okay. Just leave it this way. All right. I don't consider myself a journalist, and nobody else would consider myself a journalist. I began to take on the life of being an interviewer, even though I have a day job running a private equity firm. How do you define leadership? What is it that makes somebody tick? We're here today with Chuck Schwab, who's one of the best-known figures in the American business world, certainly has been so over the last several decades because of his ubiquitous face and his ads, but also because of the great company he's built, which is one of the leading financial service companies in the United States. He's now just written a book called Invested by Charles Schwab, and we're going to talk about that and his life, which is quite incredible. But let me start by asking you about something you made news with just recently. Your company announced that you're not really just going to do discount brokerage, you're going to give away brokerage for free. In other words, if I want to buy some stock, I call up Schwab, I have an account, and I trade for free. How do you make money if I'm trading for free?
Well, David, first, thanks for having me on your show. I had the opportunity to know you for a while, so I feel very comfortable being here and letting you know all of my secrets.
All right, well, tell me the secret of how you make money when you're not charging anything.
Well, a long time ago, we started taking commissions down, and that's how we started the business, with lower prices along the way. And finally, we got down to $4.95. I said, we're so close to zero, let's go there. And I always had somewhat of a passion for what the success of Google has been. They made search free, and they do very well by offering free search.
Right.
Similar in our case, we think we will do very well offering our services free for transactions, and that's the commodity part of the business. The rest of us, we give people, if you need help and advice on different kinds of things, managed accounts, banking, all those kinds of things. But the fundamental service we want to provide is free.
Okay, so I shouldn't worry about Chuck Schwab and not making money because we're service away for free.
You should not worry about it.
Okay.
We actually are giving up about 4% of our revenue in that decision.
Okay. So for those who don't really follow this, you started as a discount broker where you were giving lower commissions than the standard rates were before. Today, you've become a conglomerate, in fact, in the financial services world. You have about $3.7 trillion of assets under management. So you make your money on other financial services, is that correct?
Correct. But you know, one of the things, we are a conglomerate. We're really not in the original sense. We only focus on what can we do for individual investors and advisors who have individual investors.
So when you started doing this more than 40 some years ago, did you ever envision that you would be in more than the discount brokerage business? Did you say I'm going to build a gigantic conglomerate or not?
I did not, David. I mean, certainly we had a very limited view of where we were at the time, but frankly, we thought the original business only had would help maybe 10 or 15% of the population. People who did their own research and only wanted to have a simple transaction. As we found out, there are many, many people who wanted to help and advice.
So let me ask you about something that some people say makes you so well known. It's that your ads in your company for many, many years have featured your face.
I started Charles Schwab & Company from the investor's point of view. I invite you to find out more about Schwab today.
Now, was that something you decided you wanted to do?
David, it started out, obviously, our company started with a shoestring. We didn't have much money. And I had a tough time raising money because Wall Street certainly didn't want to help me develop competition for them. So as a consequence, our ads were really teeny. When we first started the business in 1975, there'd be one column by 3 inches. Come and save 75% on your. So people kept coming into our company. And as we grew over the next couple of years, we had some profitability along the way. We were growing very nicely. Once we had a nice article written in the San Francisco Examiner about us, they used a picture of me leaning over, as you remember, the old Bunko Ramo machines. And there I was, and my director of our advertising said, why don't we use your picture sometime? It'll show there's real people here. I said, are you kidding me? What's my mother going to say? What's my father going to say? What's my wife going to say? And my friends? You some kind of egomaniac? And I said, finally convinced me after some conversation. He said, just try one. We tried one. The results were up by tenfold. Because I think people thought, there's a real person behind this business, and I can identify him. I can certainly look for him in the post office. He's up on the wall there. I don't do business with him. So I think that helped. And so, anyway, my friends got over it.
But when you go walk downtown in San Francisco or anywhere in the country, but certainly in San Francisco, can you walk without having people say, there's Chuck Schwab, and come up and ask you for some stock advice or something?
Yes. Well, it happens on occasion, which I'm always honored to have that happen. But for the most part, people don't really recognize me in some sense. Maybe I part my hair differently.
So when you were starting the company in the early days, if somebody called up and said, I want to buy 100 shares of IBM, you had a broker, he or she would write down 100 shares of IBM. They then do something to go to the stock exchange.
We teletype it to the exchange at that time. Everything's written, everything's then teletyped, et cetera, to the central place in New York. Execution, we reversed the whole thing, called the client back. You bought 100 shares of IBM at $50 a share. But of course, very early on, we were very early adopters of a lot of technology to make ourselves more efficient. We just had to do that. And fortunately, I was close to Silicon Valley. Many of my friends were people in the valley itself, and I was an early adopter. And so we were one of the very first ones to sort of adopt internet in 1995, I think it was.
Now, one of the ways you got customers from all over the country, you had something in your mind to do branch offices. Why did you want to have branch offices?
Well, we found out early on, very early on, that at that time, about 50 or 60% of our customers wanted to come into a branch and make sure that real people there were behind the counter, that they could see that. And so our numbers, once we opened an office in a location, our numbers went up substantially.
So you had better technology, perhaps. You spent more money on technology than others. You had your face, which everybody got to like, and you also had the branch offices. But there's one other thing that really made your company grow from reading your book, it seems to me, is that you decided to do more than discount brokerage. You came up initially with an idea of, in effect, having people buy mutual funds through your platform.
Yeah, that was a big innovation.
Can you explain how that works?
When I first started the business, mutual funds were sold by salesmen, obviously. Got big commission for doing up to 9% of the money invested went to commissions, and the salesman got half of that, we'll say. I thought no-load funds with no commission was the best way for an investor to go about investing, which I used some of the early, myself personally, through my IRA account. I said, this is crazy. Why can't I offer this service to everybody, a no-load kind of transaction thing? So we went to the no-load companies. They're all small. So give us a little piece of your management fee, and we'll offer your fund for free to our whole network of Schwab clients. And clients loved it.
So you were the CEO from the beginning, and then eventually you had a co-CEO, and then the co-CEO had a heart problem, and he had to step back, and then you brought somebody else in, but you at one point kicked yourself upstairs a little bit, made yourself chairman.
I did.
And then somebody else was running the company, and then it didn't work out, so then you came back in for 3 years to run it again. Was that something you really wanted to do?
2004, I came back in. I wasn't sure I wanted to, but obviously I loved the company so much. Came back in 2008. I retired again as CEO. I had Walt Bettinger take over and done a fantastic job for the last 10 or 12 years.
Right.
And but I'm always sort of hanging around as the compass of the company. I keep pushing the people. We're going this way, it's north.
So when you graduated from Stanford Business School, did you say, I'm going to go join a private equity firm or a hedge fund?
As a kid, I wanted to find out how could I become successful. So I found financial services was a way to go.
So one of the causes you have is something that I'd like to talk about. You've been very open about it, unlike many people that have this problem. It's called dyslexia.
Right.
And for those who aren't familiar with it, it basically means it's difficult for you to read in the conventional way that the average person can read. But the amazing part in your book, as you describe it, is that you had it for much of your life and you didn't know you actually had it.
Right.
Can you explain that?
Our youngest son was about 7 or 8. We had him diagnosed because he had, as it turned out, all the similar and identical issues I had as a young student all the way through school. And he was now just only 7, but he had it all the way through the rest of his career. And it was a really aha moment for me to understand, yes, he got it through obviously DNA, and as a consequence, I got into it, but we both got into it, my wife and I, and we started an agency to help other parents who had identified kids with this issue. Turns out 1 in 7 people have some related issue around dyslexia, some learning difference.
So when you're young and you are dyslexic and there's no term for it yet, or at least you weren't diagnosed as that, did you just think you weren't that smart, or did your parents think, well, he's not that good a student? And how did you actually get through school?
Early on, I read a lot of comic books. I read classic comic books. They had the picture and a few words, but I got all the stories, whether Moby Dick or Tale of Two Cities. I was a wonderful student in the classics, but I got it through comic books.
But if you're dyslexic or somebody's dyslexic, does one compensate by hearing better, observing better, or being very good in math as you are?
I think it's a phonological issue, fundamentally. It's what it is. It's conversion of code to sound, and then to meaning, and then the reverse is true for writing. And because of that defect in our brain, we are slow readers.
You were not a great student, I guess, because of dyslexia in high school, but you've said in your book that maybe you got into Stanford because you were a pretty good golfer.
I was a good golfer. I don't think it makes the academics too happy that I got into Stanford anyhow. But the fact was the coach was looking for some talent in the golf area.
Did you play golf at Stanford?
I did play golf at Stanford, only as a freshman, only for a period of time, and I almost flunked out was what happened, because I was not prepared for college at that moment.
You graduated from Stanford, you went to Stanford Business School, and you did pretty well in Stanford Business School?
Mm-hmm. I did.
So when you graduated from Stanford Business School, did you say, I'm going to go join a private equity firm or a hedge fund, or what did you do?
No, I always wanted to do research. As a kid, I wanted to find out how could I become successful. That was important to me, because we came through the Depression years, my parents did, and I wanted to sort of make money and get the resources to have choices in my life. So I moved off, found financial services was a way to go. So at age 13 or 14, I began to think about this thing, stock market. Then I went to Stanford, economics, business school, all financial investment management, all that in my early career. And then I worked after and during business school for a small advisory company. I was a research analyst, portfolio manager, and I had the responsibility and the introduction to many brokers would come and sell us their stories. So I got to know the fundamentals, how Wall Street functioned. It's all by sales commissions, and some were bad incentives.
All right, so you're doing investment reports, but then eventually you realize, I guess, that you're not going to get that wealthy writing investment reports. So when did the brilliant idea come to you to set up a brokerage firm and a discount brokerage firm?
Well, it started really in the early 70s. I saw how difficult this business was. It was built upon, brokerage was built upon how well companies could make money, the brokerage companies, and not how customers really wanted to do business. So as it became in the conversation there in 73 and 74, Congress, SEC all thought that the commission system was really not a particularly good one, particularly the fixed rate thing. And so the beginnings of the end of that started then in 74. We had the test period, and then 75, boom, we went to Mayday.
So when you wanted to start the company, did you just go down to Silicon Valley and say to a venture firm, hey, give me some money, I got a startup idea?
No, there was nothing like that available to us. I would have to go to friends for a little bit of money. I had some people in YPO who thought my business was great. And that, of course, eventually led to our deal with the B of A. I went to them to borrow money. They liked our business model so much at the time, they decided to try to buy our company, and I came from nothing, as I mentioned. And so they enticed me to sell the company to B of A. I thought that was a great thing and would enhance our reputation as a discount broker, that we were associated with the B of A, the largest bank at the time. And that was then 4 years of that before I bought the company.
Well, that sounded like a great idea at the time. B of A, which is the epitome of the establishment, is buying this little kind of renegade company, which is not the establishment. You not only sell it for $52 million, which strikes you then as a lot of money, and also you got on the board of Bank of America at, I think, the age of, what, 43?
Something like that.
You were the youngest person on the board.
And one of the largest shareholders.
The largest individual shareholder, the youngest person on the board. The establishment is there, and you don't regard yourself as the establishment. So what can go wrong with that? It sounds great.
Well, it sounded great then, but then the bank fell on some bad times. We couldn't continue to do our progression of new services. For instance, one case, we couldn't even develop our own money market funds because the bank had to get permission because they were in trouble by their operational issues and loan loss issues, that we couldn't get the Federal Reserve to approve us to do our own money market funds.
Okay.
And I thought it was time that we should get out of the company.
Well, you had one advantage in buying it back, I think. You had the right to your picture.
I did. I had a name and likeness went with me, and they could sell the companies. We finally came to terms.
Who was the clever lawyer that told you to keep your name separate? Or
I don't know. I thank him every day, let me tell you.
All right, so you bought it back for, let's say, $250 to $300 million, more or less. And so how did you feel? You bought it, you sold it for $52 million, but you then had to put up $250 to $300 million to buy it back, and you had to, put up a lot of your own money to do that.
Well, David, back then, the valuation when I sold the company to B of A, I sold for about 3 times revenue. When I bought it back, I bought it for 3 times revenue. So it was about the same. We had just grown that much in that time period. So it was a fair deal for them when I sold, and a fair deal when they sold to me.
But you did what's called a leverage buyout.
I did.
And you were advised by one of the leaders of the leverage buyout industry then and now, George Roberts from KKR. And so you had a lot of leverage. In those days, leverage was higher than it is today. So you had a lot of your net worth tied up there. You also had a lot of debt ahead of you.
I had all my net worth and then some.
So you decided to try to deleverage pretty quickly, and in the same year you bought it back, you decided to essentially go public.
I did.
That was pretty courageous. Did anybody tell you that was not a good idea?
A lot of people. I said I needed to do it. I did deleverage as quickly as I possibly could, and fortunately we did, because shortly after going public, we had the crash of '87. And that was another complication.
Did that affect your business at all?
Of course it did. Our stock dropped from 15 was the IPO price right on down to 6.
So your net worth went down a little bit.
Yeah, more than half. That didn't bother me. Because we still had the company, we still had the opportunity, and having been a student of stock market cycles, I knew we would eventually return to more normal times.
As you look back on your career, the most important lesson you've taken away from what you've done, is it to innovate, pay attention to technology, be nice to people?
Have a team of people that you really honor, that work with you, because you can do so many more things with other brilliance around you.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
So your company now has a market value that is staggering compared to what it once was. I think your market value is about $56 billion, something like that. Right, $56 billion, and you are the biggest single individual shareholder still.
Yes.
So you have a net worth yourself that's fairly high. What is your view on the wealth tax? Do you think that a wealth tax is going to make society better or not, or how do you look at it as somebody like me that is subject to criticism for not supporting such a tax?
Well, I think it's sort of wrong directed in many ways. I think we as a society, and you probably don't talk about it as much, I don't either, about our philanthropy, and I feel that's an obligation of all of us. I came from really nothing and had plenty of incentive to create what we've created. And of course, my wife and I have spent a lot of time over the last 20 years giving back money to different causes that we really think need improvement, whether it's education or the art world or Alzheimer's issues, you name it, we are probably supporting that.
So you're a pretty famous face and obviously a famous person. So in California, when you're famous, sometimes you say, well, I should run for governor, senator, president. Did you ever think of running for anything?
I was suggested to be appointed Secretary of Treasury one time under the Bush administration. I thought, I just can't do it. I can't put everything in some trust and so forth. And I felt that this was my purpose in life, developing a company like this. We have benefits so many people. So politics wasn't really maybe if I was king, I like to make, I guess I like to make the things happen quickly.
So today, the way you view you're contributing to the country, other than paying taxes, building a big company, do you spend any time advising government officials, or do you do other things relating to government?
Well, I'm obviously very actively involved in politics. I think every individual in America should have some piece in the outcome of this country, and hopefully we'll hang on to free market systems for indefinite periods of time. It's provided for all of us all the various benefits of creation of new things along the way. And I think that's what what we're doing, we're at the heart and soul of free enterprise.
Now, if you look back on your incredible career, if you say, I made a mistake or two mistakes, what would you say is the biggest mistake you made that you think if you hadn't made it, you'd be even more successful?
Well, I think, David, I've made a lot of mistakes, and every mistake along the way, I think I've learned something from that.
So you have the benefit of having now 5 children?
Yes.
And 13?
13 grandkids.
Okay, so...
What a great chapter in one's life.
Do your children or grandchildren ever say, you know, can you give me a stock tip or something because I got some money? I think you wrote, I think your oldest daughter once asked you for some stock tips and you just told her to just diversify.
Well, I did, but we have a mutual fund, actually it's an index fund called the Schwab 1000. I use that all the time for my kids, the ETF portion of things. I've taught them all about it, but in some respects it's a little bit boring. I'd rather have the kids buy individual stocks. So what I'm going to do coming up this spring, we're going to introduce fractionalization of stocks. So you can buy a small fraction of Facebook.
Or Amazon. Amazon has a high price. In
Amazon.
other words, if Amazon, let's say it's trading for $1,300 a share. Some people can't afford $1,300 a share, so they could buy...
How about $130? How about $13 worth?
Okay. So that's something you're going to be doing.
We're going to do it for the young people.
Okay. So as you look back on your career, the most important lesson you've taken away from what you've done, is it to innovate, pay attention to technology, be nice to people? What would you say is the key lesson?
I think have enough humility in business that extract and have a team of people that you really honor, that work with you, because you can do so many more things with other brilliance around you. And I think that's one of the best things I've taken away from business, throw your ego aside and get with it, and a team really appreciates you honoring that.
Now, by the way, before we close, do you have any stock tips for me? I'd look for a couple stock tips. Do you have any good ideas of what I could do with my money in the stock market?
I think maybe you ought to consider, you know, I know Carlisle a lot, and you've done a fantastic job. How about an index fund?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, you know, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacroix.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Cities across the United States are gradually reopening, hoping for a quick recovery amidst a devastating pandemic and one of the biggest crises in modern history. In Boston, the COVID-19 crisis already adds up to $65 billion in lost revenue, more than double initial projections. What's the way forward?
I spent a lot of time trying to encourage people in Massachusetts, keep doing what you're doing. We can't take our foot off the gas.
And how can Boston gradually reopen its businesses and storied educational institutions?
We have to assume that this disease could be with us at least throughout this academic year.
And with its vibrant biotech sector, can the city lead the way in the race for a vaccine?
Businesses that want to stay open in the midst of this will need some level of regular testing to do it.
We speak with Boston's best and brightest, the executives, policymakers, and educators on the front lines in this special edition of Bloomberg Technology, Boston, the Road to Recovery. Welcome to a special edition of Bloomberg Technology, Boston, the Road to Recovery. I'm Emily Chang. We begin with a conversation about Boston's leadership through a health, economic, and social crisis as the city slowly begins to reopen.
Initially, it was getting PPE to our frontline workers. We had people working in hospitals, nurses and doctors, EMTs, firefighters who just didn't have the masks and the gear that they needed. And so that was a real challenge, getting PPE into the state. A second challenge was the really dire situation, people getting laid off from work, people who were food and housing insecure, especially in low-income communities, especially in Black and brown communities. And that was a real challenge and remains a challenge. And then finally, I think just adopting to how we were going to communicate. Everything has been done virtually. For doctors, it was learning to get them licensed to provide telemedicine, for example, to their patients. So a lot of challenges in the early days. Probably most of all, just not knowing what we were going to get from the federal government. And frankly, the federal government not being there to support our state or other states in the way they should have.
So what's the situation now?
I think the situation is better. I think that people have worked really hard in Massachusetts to stay at home, wear masks, and really do what we should be doing during this time. And that's why you've seen our infection rates go way, way down. You see what's happening in other parts of the country where people just didn't behave that way, and the numbers are going through the roof. So the situation on the ground here is good. Our hospitals, our incredible hospitals, have worked so hard here in the last few months. And so I feel good about that. But I'm also nervous that as we start to reopen, people will let their guard up and not take the safe measures that they need to continue to take, because we're not going to see a vaccine for a while. I think the other problem is our economy, our restaurants in particular, small businesses. So many just shut down and probably have shut down for good. So I think building and rebuilding an economy here is really important. Colleges and universities, they're a big part of Boston and Massachusetts and our economic picture as well. And obviously they're in really dire straits right now. And so there's a lot still to wrestle with. But I'm proud of the people of Massachusetts. I think everybody's really tried to work hard together to get through to this point.
As you mentioned, Boston is home to world-class universities, hospitals, vaccine makers. How concerned are you as we're seeing cases now spiking again across the country?
Well, I'm concerned because you could have students coming from all over onto campuses here in Boston in a few months. And if they're carrying coronavirus with them, they put all of us at risk here. So I'm certainly concerned about that. But I do think we are so fortunate in Massachusetts to not only have amazing life sciences, biotech, research institutions that are truly on the front lines now in developing treatments and a vaccine, in addition to really world-class healthcare. And so we're fortunate in that way. But I am nervous about spikes as we approach the fall. And I just, I spent a lot of time trying to encourage people in Massachusetts, keep doing what you're doing. We can't take our foot off the gas.
So obviously, children aren't as seriously impacted by the virus. From a health perspective, what have the cases of COVID-19 among children looked like to you? What have you been seeing at your hospital?
We have seen a number of children come through, both with the virus, but also with this new syndrome, the multi-system inflammatory syndrome in children. We've seen about 150 children with positive COVID. Most of them have had a relatively mild form of the disease, and several of them have had more need for intensive care, but they've mostly been children with underlying disease. The more sick children are the ones with this new syndrome, and we've seen just over 30 of them in the last couple of weeks. So that has been our experience, but we've been preparing for the same kind of situation that even all the adult hospitals had to as well.
So that certainly counters the point that some have tried to make that children are, quote unquote, basically immune to this virus. I mean, how concerned should we be about our children out there?
Well, children, have been testing positive. Many of them have tested positive and are not symptomatic. So the question is whether they are really also transmitters of the disease, even though they're not showing symptoms. And so that's something that we're still attempting to study to truly understand why this virus, unlike other flus, have not necessarily had the same degree of impact on children. And that's still a bit of a mystery, and therefore a lot of research that's going to go on to understand that.
What is the state of reopening there, and what's your view into how well businesses are surviving?
Well, so far it's going very well. There was a large joint effort, as you referred to, with the Mass High Tech Council, the Governor's Council, academics, business people, medical people. And we went through a huge effort under the leadership of the Mass High Tech Council to really look at the COVID-19. And this was probably 10 or 11 weeks ago, while people were focusing on fighting the virus at the hospital level. We were focusing on how would we reopen the economy once the hospitals were stabilized. And the governor and the Secretary of Health and Lieutenant Governor, I think, have done a very nice job in Massachusetts. In fact, I just saw the data today. Massachusetts has the lowest RT factor. It's 0.66 of all the 50 states right now. So far that program has worked very well.
Now, as the co-chair of Bain Capital, you've got such an interesting vantage point. What does the economic recovery look like to you? Is it a V shape or a deep V shape, as some have suggested?
Well, I think it's probably a kind of series of W's. We're going through right now nationally a second wave in many of the western states and Florida. And so that's going to, the markets dropped today, that's going to affect the economy. So it's very uncertain. The Fed has piled in with $10 trillion of government spending. And that's, I think, kept businesses going and the markets up and consumers, even with the high unemployment, spending. And therefore, it's kind of blunted the economic impact of the virus. But hopefully we can keep that up and get these other states turned around in time for some kind of therapeutics or a vaccine to come along in the first or second quarter. I'm much more optimistic about the progress they've made with therapeutics and vaccines. There's 100 and so efforts going on in the world right now to fight the virus. And we need a few of those to be successful, and hopefully they'll be successful in short order. Until then, we are going to be what I'll call an 80% economy, an economy shifting towards an e-economy. You've seen big increases in any kind of e-companies in terms of getting deliveries at home, food, goods, actually a boom in that area, where other businesses have suffered, especially businesses that require close contact.
As the economy starts to reopen, how do you expect companies to address this second shift, this shift that we are seeing on social issues, a new sort of social normal, if we will?
I think the first step is to acknowledge that companies have a problem, right? We've seen a lot of messages of solidarity going out there, but the first step is to look inside and look at the structural racism and sexism within their own ranks. And that's who's in the C-suite, who's on the board, who's holding the high-paying jobs. And so solidarity is one thing, real action is another. We actually had a shareholder proposal asking for greater action on racial and gender pay equity this spring, go to a vote at 10 different companies, annual meetings. And at all of those annual meetings, the management teams and the boards opposed the proposals. That's not meaningful change. And I wonder if that would happen now, 1 month later, 2 months later, as companies are really starting to reassess what they can do to both acknowledge the problem and change from the inside out.
Arjuna Capital, based in Boston, is an activist investor in Twitter and Google and Facebook. If these companies are going to continue to turn down your proposals, can you keep investing in them?
Well, we invest in these companies, in companies like Facebook, for instance, with the intent of engaging. We think they've got a strong platform, a strong position in the market, and we've been working for the last 4 years to press for change. And we've seen some change. I mean, you saw it's not enough because certainly there's consumers and users are unhappy. You have an advertiser boycott, but you did hear Mark Zuckerberg reference the 10 million pieces of hate speech that were removed from the platform in the first quarter. The reason we know about that is because Arjuna Capital pressed for transparency on that kind of reporting.
Coming up, from vaccines to cybersecurity, how businesses in Boston are stepping up. This is a special edition of Bloomberg Technology, Boston, the road to recovery.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Welcome back to a special edition of Bloomberg Technology. I'm Emily Chang. For the second year in a row, Massachusetts took one of the top spots in Bloomberg's annual State Innovation Index. GE, Raytheon, Thermo Fisher, and Biogen are some of the biggest companies headquartered in the state, along with potentially leading vaccine makers like Merck, Sanofi, and Moderna.
The scientific and medical community believes that the biology of a virus is druggable. And so I think there's a high probability that several vaccines will make it to the finish line. It could be as early as the end of the year or early next year.
But the Boston area is also home to more than 40,000 small businesses. We spoke to some of the city's top executives about their company's road to recovery after months of sheltering in place.
We needed a lot of clinical diagnostics in sort of the first phase, the acute phase of the pandemic, where you really had doctors making decisions about people who were sick and needing to know, do they have COVID or not? And we built up 300,000 or 400,000 tests like that in the United States in the last, kind of heroically in the last 3 or 4 months. Well, now what we need is much lighter weight testing. Ideally, it's not going to be a nurse administered swab. It would be something you could do yourself, either saliva or in the middle of your nose. And it would be collected just at your workplace. You wouldn't have to go anywhere. And you would do it maybe depending on how acute the outbreak is in your area, once a week or maybe once every 2 weeks, depending. And you need to actually model that. You have to do a little bit of epidemiological modeling to know, but that would be the idea.
What's been the interest from companies and schools so far? I mean, there's still so much uncertainty, and I'm sure many of them don't really know how often they're going to have to do this and for how long.
Yeah, I mean, it's really hard, right? I mean, a ton of interest, but I think there's also just people are confused about this, and I think rightly, because we haven't, the last time we dealt with a pandemic at the scale that would close down the global economy was in 1918. It was 100 years ago. And so, of course, we don't have any of the infrastructure built to do this well. And so, we're seeing a lot of interest, especially among schools that are trying to open, but also really major employers. And again, it's partially a workplace safety issue, but Emily, it's also business continuity, right? Tyson had to shut down 6% of poultry production in the U.S. Ford had to close the F-150 plant. Businesses that want to stay open in the midst of this will need some level of regular testing to do it.
DraftKings is based in Boston. Curious how you've been engaging with the city of Boston as you plan for a return to work as everything has been shut down, and now the economy is starting to slowly reopen.
Now, first of all, our initial focus and continued focus primary focus, I should say, is on making sure our employees are safe. They have an environment that they feel comfortable working in from home. As people talk about returning to work, we're ensuring, as per guidelines, that only the people who absolutely have to be in the office are coming back. And, we're also continuing to try to help with job growth. We've made 0 layoffs. We've continued to hire. And we're hopeful that we can even accelerate that more. But right now, we're continuing a pretty rapid pace of hiring, even through the pandemic.
You went public in the middle of a pandemic, and even more impressive, during a freeze on sports. What's it been like leading the company through this time?
It's been really interesting. It's when you think about early on as you start a business where you're going to go, usually you don't even think about going public. And if you do, you probably think about ringing the bell and kind of the typical setup, not, virtual bell ringings and, not seeing your employees for months at a time while you're going public. So it's been an unusual and, unexpected way that we did it. But overall, it's been really successful. We've been thrilled with the receptiveness that the market's had to us. Really, appreciative of all the people that have invested in us and believe in our vision and what we're going to hopefully be able to achieve. And, for us, a lot of it comes down to just continuing to execute well, hoping that states continue to progress with legislation. I'm hoping Massachusetts will get something done in the near future, because that obviously helps us continue to build our base here. And, if we continue to execute well and good things happen on the legislative front, I think that, things will take care of themselves on the financial side. And it's obviously distracting having a public stock price now, but trying not to watch it every day.
Many people don't realize that even though Converse is owned by Nike, you're based in Boston. What's been the process of retail stores closing, reopening? Where do things stand now?
Yeah, quick one there. It's, Converse was founded over 120 years ago in New England, in Malden, Massachusetts. It's headquartered in Boston, and it's a wholly owned subsidiary of Nike. And it's kind of connected, but really independent. And so I'm based there, as well as hundreds of other employees are there. We do business in over 100 some odd countries, and North America is one of our key markets. As far as your question is around stores, Asia, fully operational. I'd say Europe, half and half, depending on the country and where they are in their kind of curve. And in North America, probably around half our stores are opening, and every day that changes based on kind of local government, regulations and what's going on in the shopping environment.
Right. Talk to us about what's happening regionally and what trends you're seeing.
Yeah, well, first, the biggest trend that we've seen, first, a trend that's already been there, which is that move to digital, with consumers buying and shopping and engaging with brands through their mobile devices. That just accelerated in the last 90 days. So no matter what market you're in, that's grown at a very, very fast pace. But what's been really interesting is that as we've opened our retail stores, or our partners have opened retail stores in Asia and Europe and now in North America, our consumers wanting to get back out in the marketplace to shop and interact and be back with the brand has come back faster than we anticipated, which has been very, very good.
Now, speaking about supply and demand, my producer was surprised to find that the shoes she wanted to buy for her toddler were sold out. What's the story on the supply side?
Well, you'll find in the world of sneakers and fashion, as you would know, that it can be sold out for many different reasons. One is we didn't make enough, or by design, scarcity is a part of the fashion model, that you make enough to what you think is going to satisfy a certain set of demand, but that you'll move on to what's next. So without knowing the exact shoe, I don't know. But what I can also tell you is that every brand is challenged right now as digital is accelerated. There's a certain pipe that enables you to go from idea in your mobile device to consumers' homes. That pipe hasn't really gotten much bigger, but consumers' demand using digital is up multiple rates. And so the pipe is full. And so what you'll find a lot of times is it's just taking longer for you to get your favorite sneaker or apparel than it would have been before COVID-19.
How much is this working from home just going to be part of our new habit?
I think it'll be very substantial for companies where employees can work from home. I think you'll see a large fraction of employees continue to do that. We've told our employees that they can work from home for the rest of the year. And I expect, in the long run, maybe half of our employees will do that on a regular basis going forward. Sometimes employees need to come in, but for a lot of companies right now, they can work very successfully remotely, and that's safer to do, and in many cases more convenient for the employee.
Coming up, from the lecture hall to virtual classrooms, how some of the nation's top universities are adapting to the crisis and planning optimistically for the gradual return to campus. This is a special edition of Bloomberg Technology, Boston, the road to recovery.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We return to a special Boston edition of Bloomberg Technology. The pandemic is upending higher education, perhaps in Boston more so than anywhere else in the country, with more than 24 colleges and universities in the area. Campuses have shut down and moved online. Now the big question is, when will students return, and how will campus life be different?
If you look at this virus, one of the most insidious parts of this virus is the fact that it has a significant either asymptomatic fraction or what I call pre-symptomatic, where people can shed virus and infect other people, but they don't have symptoms. And because of that, we made the commitment back in April that we're going to do very significant PCR-based testing of our entire community. We rolled that out last week, and that will be testing everyone as they come back in the community to try to make sure that we're not bringing virus in, and then frequent testing of everyone that's coming in contact with the students and faculty throughout the semester.
Now, when it comes to COVID-19, are you anticipating integrating distance learning and a more flexible curriculum for, potentially 1, 2, 3 years to come? I mean, how long term will this be?
Well, see, I was raised to plan for the worst and hope for the best. And so I believe that all the things we put in place and the way we're talking about it is what we refer to as the new normal, is how we operate a residential university with COVID-19 in our midst. And I would love, like everyone else, to wake up in January and have a widely disseminated effective vaccine, but I don't think we can count on that. We have to assume that this disease could be with us at least throughout this academic year. And everything we are doing, every decision we're making, is to establish the kind of continuity we need to operate as a major research university throughout that period.
Do you see being integrated into the curriculum now, potentially more so for years to come, given the experience that parents and schools have had with your program over the last 4 months?
Given how unusual this back to school is going to be, whether it's a shift-based model, socially distanced model, hybrid model, I think there's just a reality that people are going to have to lean more on Khan Academy and video conferencing than they might have at any other time. And I do think some of this is going to have long-lasting implications. One silver lining of all of this is that people have been talking about the digital divide forever. And it's been very clear that as soon as the school closures hit, that there's a subset of kids, 20-30%, who didn't have adequate internet and computers at home. That has always been a barrier for them to be able to adopt tools like Khan Academy. People are really serious about solving that. So I think it's going to allow, if that gets solved or gets closer to being solved, the whole system can lean more heavily on things like this than they normally would have.
And that does it for this special edition of Bloomberg Technology, Boston, the Road to Recovery. I'm Emily Chang. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Every which way and up, the markets continue to push against COVID-19 anxieties, and tech leads the way. This is Bloomberg Wall Street Week. I'm David Weston. This week, Governor Phil Murphy of New Jersey.
It's not a one and done. We got that out of the way, check the box, we're good to go. This is an iterative reality that we're living with.
Governor Ned Lamont of Connecticut.
I think you're going to see a dynamic change. Let's face it, for the last 20 years, young people wanted to be in the major metro centers. Now I think there'll be a little balancing out.
Former senior economic advisor to President George W. Bush, Glenn Hubbard.
The stock market may have irrational exuberance, but it's not obvious. But even if the stock market's high, doesn't mean the economy's fine at all.
Sharman Mosavar Rahmani of Goldman Sachs. And we bring back our roundtable, at least virtually, with contributors Larry Summers of Harvard and former Fed Governor Dan Tarullo. Nowhere to go. That's what the markets seem to reflect this week, as concerns about a resurgent coronavirus were overcome by a general sense of optimism. That and a good deal of liquidity that was burning a hole in investors' pockets. For many, it seemed there truly was no alternative.
Institutional investors are more confident than at the moment than about a possible crash than our retail investors.
But maybe for the first time, investors started to think about some real alternatives in Washington as President Trump's poll numbers continued to slip and Wall Street took a hard look at a possible Biden presidency and maybe even a Democratic Senate. To give us a peek now into what the markets might be thinking about, we welcome Sharman Mosavar Rahmani. She is Chief Investment Officer for Goldman Sachs Wealth Management. Sharman, welcome. It's good to have you on Wall Street Week. Give us some sense of what the markets are thinking, because there was enough reason to really pause this week when you have increased COVID-19 cases throughout the South in particular. You've got some problems with China. Maybe there's not going to be a phase 2 deal. You've even got a Joe Biden and maybe a Democrat Senate. So why are the markets continue to push up so relentlessly?
There's always things to worry about. In fact, we often use the expression that the markets climb the wall of worry. So the fact that there's more COVID incidents in the South and the West, and we actually are seeing fatalities go up, is definitely something to watch very carefully. But when we actually look at the turnaround in the economy, that's been quite dramatic. So we have gone from a steady decline, numbers looking pretty terrible on the unemployment insurance claims, the first-time claims being up like 6.8 million people at the peak, to now something like 1.3 million. So we're seeing a very big shift in the economy relative to what people were expecting. The data has surprised to the upside, whether we're looking at retail sales, whether we're looking at car sales, whether we're looking at mortgage applications, whether we're looking at the ISM manufacturing and non-manufacturing surveys, consumer confidence. So things are clearly improving, and the market is moving from pricing a very bad environment, to where some people even use the term depression, which we never used, to actually being more optimistic that maybe 2020 will be a year that's down about 5% plus or minus a little bit in terms of economic growth. And then we recover by about 5 or 6% in 2021. So our view is that this is not an irrational market. Equity markets are forward-looking. So they're looking at what earnings will look like in 2021. We're already in July. There's a sense that from some of the early reporters, those who reported at the end of May, that actually they have beaten expectations. And so there's some sense that that's going to be positive. And when we're looking at these numbers, we're saying we know that as long as people do follow the guidelines, which is a big if in terms of social distancing, in terms of wearing masks, we are going to have some prospects of therapies in later this year in the fall. We're not that optimistic about vaccines being broadly available at the end of this year. It's much more of a 2021 issue. But so overall, when we look at the numbers, we don't think the market is at outrageously high levels at all.
Sharman, maybe the biggest headline about the markets this week was large cap tech. I mean, they're really big. The FANG stocks really drove this thing to a large degree. How broad is the increase in the markets, or how confident are the markets, or is it really just a relatively handful of companies that are driving an awful lot of this?
We actually look at a series of indicators. We do look at the advanced decline numbers. We're looking at percentage of stocks that are above versus below over the last, let's say, 10 days, 50 days, 30 days, what the moving averages are. We look at a broad range of market technicals as well. And there is some divergence. So if you're looking at growth stocks versus value stocks, if you're looking at the energy sector or financials, we actually don't think those are sectors that will drive the market, but it is not that narrow that is only the FANG stocks. The healthcare industry is actually doing very well. There are other sectors of the economy. So we think it's more broad-based than people actually acknowledge.
So Sharman, you said immediately it's because the economy does seem to be coming back perhaps faster than we thought. Let me give you an alternative explanation, which is the Fed has really taken the rates down so terribly far, and it really makes there's almost no alternative. The yield is so much worse anywhere else, as opposed to the underlying fundamentals of the economy driving it. What about that?
When we think about equity markets and equity market valuations, we look at a couple of different components. So when we look at equities, we do look at the equity risk premium, meaning looking at equity valuations versus bond valuations. So there's no doubt that such low interest rates across the board do provide some support to the equity market. But we also think the equity market is not that expensive. When you look at equities in periods of low and stable inflation like we are in right now, and we expect to be in for the foreseeable future, equity valuations are consistently higher. So relative to that environment, we're maybe 10 to 15% overvalued. That is not enough to compel us to say clients should be underweight equities. We actually recommend clients be fully invested at their strategic asset allocation. So whatever the client's risk tolerance is, that is where we recommend our clients be. So our view is that this is actually a market that is trading on fundamentals. The underlying growth is actually real. It's not just driven by the low interest rates.
What about alternatives, Sharman, to, for example, U.S. equities? And let me give you one specifically. People talk about gold or talk about bonds, things like that. What about European equities? Because if this really is a race about how to deal with the COVID-19, right now it looks like Europe's doing a better job of that than the United States.
You're quite right. You can look at all the mobility data from some of the more high-frequency sources of data, and you notice that Europe is in line with the U.S. in terms of the economy's reopening, and yet the huge spike that we have seen in the U.S. and, again, the South and the West with specific states, you're not seeing at all in Europe. And that is really a function of people not wearing masks, not following the social distancing guidelines. It's not because they have better fiscal stimulus. It's not because they have a better monetary policy. It's not because they have a better earnings outlook. In fact, if you think about what you just mentioned earlier in terms of technology stocks, information technology in aggregate is a much bigger part of the S&P 500 versus European stocks. So when we look at that, we actually at the margin do have a U.S. preeminence view. It's a view we've had now for over 10 years. When it comes to looking at European stocks, and that includes emerging market stocks as well, we do recognize that they're trading at a significant discount to their long-term averages, but we actually think that is justified. We think Europe will be much slower to grow. We think that when it comes to a coordinated policy in terms of fiscal and monetary policy, it's been a little bit harder. We already know, for example, when people have questioned the ECB policy of buying bonds, whether it's legal or not legal, we don't have those issues with the Federal Reserve. And when it comes to fiscal policy, the U.S. has been much faster and much more aggressive. So when we combine the level of innovation, the role of technology, and these other policy factors in the U.S., we actually think that the U.S. is a better place to be than any overweight to Europe or emerging markets.
It's fascinating. Thank you so much, Sharman. It's really insightful and very helpful the way you're looking at it at Goldman Sachs. That's Sharman Mossavar-Rahmani. She is the Chief Investment Officer at Goldman Sachs, and she says that we should stay invested in the equity markets despite the fact that they keep pushing up, in part because the fundamentals of the economy may well justify it, and she thinks that equities really may not be overvalued after all, which is very good news in the end. Coming up, the markets are one thing, but the underlying economy could be something quite different. We talk with Glenn Hubbard, head of the Council of Economic Advisors under President George W. Bush.
Sometimes we forget the stock market's not the economy. It's dominated by some very large firms, some of which have market power.
This is Wall Street Week on Bloomberg.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on. Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
How do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions, as they have in Japan over the past decade? And how do we factor that assessment into monetary policy?
That was Fed Chair Alan Greenspan back in 1996 during the lead up to the tech bubble. Well, we may not have a tech bubble this time, but we certainly have a tech surge, which is helping drive the stock market overall up in the middle of a recession. Glenn Hubbard of the Columbia Business School led the Council of Economic Advisors under President George W. Bush, and he has his own perspective on whether what we're seeing today is a new version of irrational exuberance.
It's not clear. I mean, the jobless claims numbers are good news, but there's still 32.9 million people on some sort of unemployment benefit. That's 20% of the pre-COVID labor force. That's not good. So why is the stock market high? I expect there's a few factors. One, the value of stocks, of course, is the whole future of earnings. And so if you're relatively optimistic about a recovery, most of the future is still fine. Second, the Fed's interventions have pushed down the discount rate for stocks and risk spreads. And third, sometimes we forget, the stock market's not the economy. It's dominated by some very large firms, some of which have market power. So the stock market may have irrational exuberance, but it's not obvious. But even if the stock market's high, it doesn't mean the economy's fine at all.
And is it possible we'll have a second wave here on the unemployment? I mean, I don't wish that to happen, but we had United Airlines saying they may have to lay off 36,000 people. We had Boots say 4,000 people. We've got Wells Fargo saying they're going to have to lay off 1,000 people. Is it possible as you get into the second half of the year, companies are saying, how can we have this be sustainable over the long term? We have to winnow our staffs.
Well, it is, David, for two reasons. Familiar in economics, supply and demand. So on the supply side, it may be that there's just not enough activity. In other words, that people have decided not to return to traditional activities. That slows hiring and rehiring. But the others on the demand side, we could have business failures as a result and credit market problems. So policy really has to provide some insurance against this kind of outcome. And of course, the virus itself may rear its ugly head again, which puts a lot of focus on vaccines and on therapies.
And Glenn, one of the subjects that you've raised time and again is the demand issue, where there might even be demand destruction. Is there anything that we can do in a further round of stimulus or otherwise? What's the best plan to try to make sure we shore up the demand side as well as the supply side of the economy?
Well, it's a great question. I think there's two things, insurance and interconnectedness. And by insurance, I mean providing insurance that we don't fall out of bed in the economy. And by interconnectedness, realizing how businesses are interconnected. So on insurance, I would continue support for unemployment insurance, but not with the $600 additional benefit, which I think may have discouraged some people from going back to work. But there are ways to use triggers of state-level unemployment and replacement rates to provide some extra benefit, but just not quite $600. We also need to give funds to states to help make up lost revenue, to help support community colleges that are going to be critical in rebuilding and retraining people. We'll need to continue support for small and mid-sized businesses. These are things like the Federal Reserve's Main Street lending facility. And we need, finally, more support for work, what I and others have called a pandemic earned income tax credit.
Well, take us through that, because I think we're basically familiar with an earned income tax credit. How is a pandemic earned income tax credit different?
Well, you want to support low-wage work and give people reasons to go back to work. From my way of thinking, the earned income tax credit is already a strong mechanism for encouraging low-wage work. We need to make it more generous. During the pandemic, we could increase its size significantly, proposed in a recent piece doubling it, but also making it available to childless workers. That is something that would really provide a boost to low-wage work when we need it, and probably a bridge to future policy, but definitely in the pandemic. Remember, unlike in the CARES Act, we're now in a phase where the economy's reopening. Our goal is to help connect people back to work, and that ought to be our mindset.
You also mentioned the unemployment insurance support, that we had this flat $600 payment. Some people are saying that that might have actually encouraged, ironically, some people not to go back to work because they could make more money by being unemployed. You have come up with a proposal with Jason Furman, another former director of the Council of Economic Advisors under a different administration, where you would sort of feather that down and tie it state by state into unemployment.
Yes, in two ways, David. One would be to make it as a replacement rate of wages. So you're not going to get figures as high as $600, but you'd still get extra unemployment insurance. And second, to key it off the unemployment rate in the state. So there would be triggers. If an individual state had a very high unemployment rate, these additional funds would be there. They would phase out as the unemployment rate goes down. That does a couple of things. It enables you to have a program that's robust to whatever the shape of the recovery is. We don't know sitting here today whether it's a V shape or some other shape recovery. It also avoids having to bring the Congress back to take action every time we learn something about the crisis. It puts the unemployment insurance expansion more on a trigger program linked to the economy and not to politics.
That was Wall Street Week contributor Glenn Hubbard. Coming up, rebuilding an economy in ways that address great and growing economic inequality. We hear from Wes Moore, head of the Robin Hood Foundation.
And this initiative really allows us to address poverty through the lens of this interplay that exists between racial injustice and economic injustice.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. As we rebuild the economy to the tune of trillions of dollars, are there ways that we can rebuild smarter? Ways that we can make sure everyone has an opportunity to participate and ultimately to succeed? Wes Moore is the CEO of the Robin Hood Foundation, dedicated to fighting poverty. He's also the author of a new book, 5 Days, The Fiery Reckoning of an American City.
I'm a Baltimore native, and in many ways, Baltimore City helped to raise me. And one of the things that really struck me about Freddie's story was, I unfortunately have been to many funerals before my life, but his funeral was the first funeral that I'd ever been to when the person who was laying in the casket I never knew in life. And that haunted me. because Freddie Gray's funeral was a big deal in Baltimore. But then the thing that really helped to trigger wanting to write this book and tell this story was not just the horror of his death, but in many ways the horror of his life. And that's what I wanted to uncover.
And you say, I'll just read a bit from the prologue here. You say, we had come from similar places, you and Freddie Gray, but I had been so fortunate, so blessed. And you go on to talk about your mother and your grandparents and the breaks you got along the way. How does it happen that two people with similar sorts of situations can take such divergent paths?
Well, I think that one of the things I wanted to be able to look at is when you look at the life of Freddie Gray, for so much of us, particularly for individuals, all of us, who feel like we're coming out from the margins, right? Where this wasn't always destined, that we could end up being there. There are a lot of factors that play into it, but one of the big factors that plays into it, unfortunately, is luck. It's getting a break that someone else might not get, an opportunity that someone else might not get, and the idea that we would have or can have a society that is relying on luck as a prerequisite in order for people to be able to move from one position to another position is really hard. And so it gets back to this larger point of, did Freddie Gray even have a chance? Did he even have a shot? Or was that last interaction that he had where he died, was killed in police custody for the crime of making eye contact with police, which triggered probable cause? Was that the last system to break in the life of Freddie Gray?
Well, see, that's what I found. One of the things I found very powerful in this book is, obviously, what happened with the police was inexcusable. Police officers were indicted, although I don't think they were convicted. But it was inexcusable what happened to him in that police van. But the problem with Freddie Gray started way past that. And when you talk about systems, we talk about systemic racism, systemic inequality. It's a series of systems. There's a lot of systems here that put Freddie Gray in the wrong place, and for that matter, put police in the wrong place at the same time.
That's exactly right. I mean, when you look at the life of Freddie Gray, every system failed him. The education system, when the last day of attendance that he had recorded in Baltimore City Public Schools was in 10th grade when he was 19 years old. He had been in special education developmental coursework his entire academic career because of the lead poisoning. The CDC indicates that 5 microbes of lead in every deciliter of blood is enough to give a person cognitive damage for the rest of their life. Freddie Gray had 36. And so this was a young man who from the earliest ages, from being a toddler, was going to be cognitively damaged for the rest of his life because of something he had absolutely zero to do with. And that was that the fact that the home that he was living in and the water that he was drinking was making him sick. And so when you're looking at all these various systems that then were in place and just were not in place in the life of Freddie Gray, it forces all of us to understand that this is not just going to be about policing. Reforming the police department is necessary and it is imperative. However, we also have to understand that the amount of systems and the amount of touches that Freddie Gray had in broken systems throughout led to the idea that last interaction with the broken system, with that one broken system, was just kind of a continuation of a lot of the larger life challenges that he was facing.
So as you say at the end of your book, we kind of know what the problems are. There's been a lot of studies. The question is, what do you do about it? And as we turn to that question, let's first of all talk about the respective roles of philanthropy and the government and basically public policy on the one hand and the other. And you obviously are involved in a philanthropy, a very important poverty-fighting organization. Talk to us about the Power Fund.
Yeah, so we're really excited about the Power Fund. It's a new initiative that Robinhood is launching, and it's to fund and to elevate nonprofit leaders of color who share Robinhood's mission and of increasing mobility from poverty. And this initiative really allows us to address poverty through the lens of this interplay that exists between racial injustice and economic injustice, where there is a complete overlap. Because if you look at the data around poverty and you look at the data around race, you see that race is a predominant and a leading factor in every single one of our data categories. So everything from life expectancy to health to wealth and income to maternal mortality. The role that race plays is undeniable, but also when you think about philanthropy, over the past 2 decades, only around 10% of all philanthropic dollars have gone to organizations that are led by people of color. So you see that, and also on the absolute basis of the capital, it's even less. And so philanthropy, our field, we fund fewer and we fund less when it comes to organizations that are led by people of color. So the Power Fund is really seeking to expand our funding to significantly increase leaders of color-led organizations by providing self-directed leadership, capacity building, funding, and supporting this field that we know is incredibly important if we're ever going to address this issue, because the people who are closest to the challenges are oftentimes going to be the ones who are closest to the solutions.
That was Wes Moore of the Robin Hood Foundation. Coming up, we hear from two of the governors hit worst by COVID-19, Governor Phil Murphy of New Jersey and Governor Ned Lamont of Connecticut.
It's quite clear that this virus is a lot more lethal inside than it is outside. And so we're watching this minute to minute.
I listen to governors from Florida and Texas and the such saying they regret that they did open their bars when they did.
This is Wall Street Week on Bloomberg.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This is Wall Street Week. I'm David Weston. New Jersey is one of the states hardest hit by the coronavirus and most aggressive in dealing with it. After having some real success, cases are on the rise again, leaving its governor, Phil Murphy, to decide what to do next.
We made the decision based on the facts and the science to begin step-by-step reopening our state. So we knew when we were doing that, doing it responsibly, I hope at every step, that we would take on more risk in terms of increasing the potential for transmission. We were comfortable with that risk. What we were not expecting was the explosion in cases elsewhere in the country. And so the rate of transmission has gotten a little bit uncomfortably high for us, just over 1. Today it improved slightly. And so we put in with New York and Connecticut a travel advisory for folks to self-quarantine if they're coming back into our state from a hotspot. We are now requiring face coverings outdoors. Those are 2 steps that we've taken over the past 10 days or so. We've held off on indoor dining, which brings me no joy, but it's quite clear that this virus is a lot more lethal inside than it is outside. And so we are watching this minute to minute, and again, trying to make the decisions at every step based on the facts.
What are your plans at this point? To what extent are you planning on people actually being in the classroom as opposed to remote learning?
Our bias is to get kids back into the classroom. That's the starting point, but we have to do it responsibly. I think, David, the toughest nut to crack is going to be preventing the unwitting passing of the virus from an asymptomatic, young, healthy kid to an older educator or administrator or someone with underlying health challenges. So the whole notion of capacity constraints, social distancing, face coverings, lots of hyper hygiene, et cetera, doing things outdoors wherever possible. Those are all going to be elements of what we think it will look like.
There will be some things that no doubt will be statewide. Let me talk about testing. For example, are you considering requiring that every person, every instructor, every member of staff be tested before they go back to school to teach and serve the students come fall?
If we could do it, yes. We have a daily capacity right now in New Jersey that is somewhere 25 to 30,000 tests a day. Absolutely. The only obvious point to make is even if we're able to achieve that, and I think we could achieve it, this is a virus that doesn't just, it's not a one and done. We got that out of the way, check the box, we're good to go. This is an iterative reality that we're living with. And that's the only caution I would say. This is until we have therapeutics that are developed explicitly for COVID-19, certainly until we have a vaccine, we've got to keep coming back to testing and tracing and doing the right things.
I understood that, in fact, your budget is balanced through September 30. That sounds like you've got a little time to work with it.
Yeah, it's balanced because it's constitutional. It's a constitutional requirement. But in order to get our budget balanced literally only for 3+ months, David, we had to cut or defer $5.2 billion of expenses. The nut for New Jersey, we have estimated between mid this year and the end of 2021 is $20 billion. That's the amount of, that's how overwhelming this crisis has been, both in expenses that have exploded and revenues that have fallen off the table.
Are you going to have to borrow money? And if so, what does your access look like to the municipal bond market at this point? New Jersey has not always had the best credit.
Yeah, we will have to borrow money. This is not either or, it's and both. And we'll probably have to put some revenue raisers on the table as well as we develop our next budget. The first place we'll go is the Federal Reserve special program that they've set up. And that'll be the first port of call. And we'll go from there. But this is going to be and both. Borrowing, I'm sure, in the billions and needing federal cash assistance. And again, we're not alone. This is an American challenge right now. And sadly, we're seeing this virus explode around the country. The other states are in our prayers. We wish nothing but a speedy resolution. But it's a reminder that we're all in the same boat together.
Governor Murphy of New Jersey is facing a rising number of cases. But just to the north, his counterpart, Governor Ned Lamont of Connecticut, has a different situation. His numbers continue to go down, but nevertheless, he is postponing further reopening because he's seen some of the difficulties his fellow governors have faced.
We've got about 95% of our economy open right now. But when it came to bars and nightclubs and big entertainment venues, I listened to governors from Florida and Texas and the such saying they regret that they did open their bars when they did. And that was an opportunity for some super spreading to go on. We don't want that to happen. So in abundance of caution, we're not going to open them yet.
Well, an ounce of prevention is worth a pound of cure, as I recall, which makes good sense. How concerned are you about people outside of Connecticut? Certainly some surrounding states, even New Jersey now seems to be ticking back up, but certainly in the South and the Southwest, there are concerns about people coming from those locations into the states up here in the Northeast. How concerned are you about that? I know you have a quarantine in place. Is that advisory, or can you enforce that?
I'm very concerned. Thankfully, we got good neighbors. Massachusetts, New York, Rhode Island, they have low infection rates. But you're right. If people are flying up from Miami, flying up from Houston, coming in unchecked, that's a problem. You need one or two people infected on that flight. By the time it lands, who knows what's going to happen. So we do have a quarantine in place. It is voluntary. That is true. But I'll tell you, the number of people flying into our state from those infected areas has dropped quite a bit, which is the precaution we wanted.
Governor, when you were last with us, you said that you thought perhaps the days of the routine 5-day-a-week commute from Connecticut into Manhattan may be over. What changes in patterns have you seen since then? Has that reinforced your view, or do you have a somewhat different view?
No, David, it really has reinforced our view, especially in southern Connecticut, where a lot of people would get on the train, then they get on the subway. There's a lot of reluctance about getting on the train, a lot of reluctance about getting on the subway. And I think people have found that you can have a nice suburban lifestyle, or maybe live in one of our small towns or Stamford, Connecticut. You can work out of there 2 or 3 days a week. And if you have to get into the Big Apple to take care of business, you could do that, but you don't have to live there.
What longer-term changes besides the commuting issue you just raised are you taking a look at right now? I'll give you another example. There are a lot of reports of people in Manhattan looking for houses up in Greenwich, up in southern Connecticut, and out in New Jersey. And what's going on with the real estate market right now?
The real estate market is very, very busy. People coming from New York, people coming from Boston. I think if they feel like this may not be the end of the end when it comes to the nature of self-quarantining, if you have a house with a little backyard, or you can get a couple of extra rooms at less cost than perhaps Brooklyn, it's a pretty good place to be. So I think you're going to see a dynamic change. Let's face it, for the last 20 years, young people wanted to be in the major metro centers. Now I think there'll be a little balancing out.
That was Governor Ned Lamont of Connecticut. Coming up, the Roundtable comes back to Wall Street Week. We talk with contributor Larry Summers of Harvard and former Fed Governor Dan Tarullo, also of Harvard. This is Wall Street Week on Bloomberg.
Economic recovery from the COVID-19 pandemic has come in fits and starts. The Fed has taken unprecedented steps to prop up the U.S. economy since its emergency meeting on March 15. The central bank slashed the Fed funds rate to zero and announced an immediate and unlimited quantitative easing program.
Well, the primary response to this challenge will come from our healthcare providers and policy experts. Economic policymakers must do what we can to ease hardship caused by the disruptions to the economy and to support a swift return to normal.
On March 23rd, the Fed announced a sweeping set of measures, including 3 new emergency lending facilities to support up to $300 billion in new financing for firms.
I do think that the confidence provided by the Fed has allowed more normalized markets to return and to get a real two-way flow in markets that are just fundamental to the support of our economy.
On April 6th, the Fed unveiled its Main Street Business Lending Program under the authority granted to it under the CARES Act. The Fed pledged to extend $600 billion in credit to small businesses and expanded the program at the end of April.
On Main Street and frankly on all of the other facilities, we expect all of them to be stood up and ready to go by the end of this month. I don't say that it won't be a day or two into June.
The Main Street Lending Program went into effect on June 15th, but has struggled to drum up interest. Of the biggest U.S. banks, only Bank of America has agreed to use the program to lend to new customers. As coronavirus cases surge in several states, the path of the economic recovery looks uncertain.
People are getting nervous again. Business leaders are getting worried. Consumers are getting worried. And there's a real sense that this might go on longer than we had hoped.
Now, the Fed's monetary policy tools could be coming up against their limits.
They're doing everything they can. They're doing everything they should. I applaud them in the fog of war to have been so coherent and so quick off the block. But I think it can't go on forever.
The central bank could join some of its global peers to cut rates below zero, but the Fed is holding off on such a drastic measure.
The jury's out as to how effective they've been
and whether they've actually helped growth.
And now to talk about what the Fed has done, what it should do, what it can do, I'm delighted to say we're going to reintroduce our roundtable discussion. A little different in the time of COVID. We aren't sitting around a table physically, but virtually we'll do it. And we have with us Larry Summers, our special contributor we have with us every week, of Harvard, former Treasury Secretary, and also Dan Tarullo, former Federal Reserve Governor, now also up at Harvard at the law school. So, Dan, let me start with you because you've been in the room in some very difficult times at the Fed. And let me go to the real heart of it. Every time we hear from Jay Powell, he says, you know, the Fed, we only lend, we don't grant. Are they close to going over that line at this point? Because they're making some loans. I'm not sure that they'll get repaid.
Well, David, remember, the constraint on the Fed is that when they stand up an extraordinary facility under their authority of Section 13.3, they're not supposed to lose money on the facility. A particular loan can go bad and still have the facility protected. And that's the reason why the Treasury Department puts in what's the equivalent of equity in order to absorb any losses that may come. But the broader issue you raise is one is of whether the Fed should be in the business of making quasi-grants. And I think that's what's really being debated right now, because one of the reasons why the Main Street facility is not being used is that at least at this time, mid-sized companies that need credit, genuine credit, can get a hold of that credit. And so at this moment, the mid-sized companies that are struggling probably need something that looks a little bit closer to equity than it does to credit. And that, as Jay Powell continues to say, is not at least at present understood to be part of the Fed's mandate.
So, Larry Summers, what about from your perspective? Has the Fed done everything it can do, and is it possible it's gone too far, going into quasi-grants, as Dan says, as opposed to just loans?
I think in the fullness of it all, the Fed should get high grades for its boldness. I think it's recognized that in crises like this, there's more to fear from doing too little than there is to fear from doing too much. I worry, though, that a Fed-first strategy is a financial markets first strategy. And I'd rather see us put a little more effort into insuring the economy and a little less effort into insuring the markets. The big gaps are about to loom with respect to fiscal stimulus if Congress doesn't get moving and pass a follow-on to the various CARES Act provisions that are expiring at the end of July. I think Jay Powell's right to be careful about involving the Fed too much in basic political decisions about the allocation of credit. You know, here's an analogy that helps me at least think about it. There probably are people who think that if the Supreme Court would get involved in adjudicating the issues around police behavior, they do a better job than anybody else. There are probably people who think they have credibility beyond what other people have. There are probably people who would rather not take political responsibility for it and would like to offload that task on the Supreme Court. But I think if somebody tried, the Supreme Court would resist, because it would recognize that in a long run sense, becoming so involved with politics would corrode its role. And I think that's the kind of challenge that the Fed faces. And I think all things considered, Jay has navigated pretty well, but his errors certainly have not been of being too passive.
Yeah, it's a really great point of the Supreme Court. Having worked there a while ago now, I'll tell you, the Supreme Court is concerned about its political capital, and you go out on a limb there, and it could get really sawed off behind it. But Dan, Larry raises a really good point. The Fed clearly has the ability to get asset values up. Does it really have the ability to affect the underlying economy and get it growing?
So I think, David, there are a few things here. First, there's the institutional role, which Larry just alluded to. You know, whether or not the Fed could, within its legal mandate, actually begin to provide real economy kind of funding is one question. The other question is whether it's desirable for them to do that. And, just as we've seen the debates already as to whether the Fed should be supporting companies that don't maintain a certain percentage of their pre-COVID employment, just as we've seen the Bank of England now coming under pressure not to provide credit to companies that have not committed to a zero admissions target. I think those kind of political issues are definitely going to affect the Fed if it tries to get deeper into this business. And I think Powell and the rest of the board are very much aware of that. But then you've got the additional issue of, even if the Fed were willing to do it, and even if it could manage legally to do it within the Federal Reserve Act's mandate, does it really have the technical capacity to do it? I mean, the Fed has bank examiners and bank supervisors who are pretty good at making sure that banks don't overextend themselves, but they don't have people who are experienced in, and they don't have the numbers that would be necessary to make the kinds of judgments that really are needed if you're trying to decide, for example, will this company have a good prospect in a year if only it can make it through the COVID problem now? So I think there are legal issues, there are institutional issues, and as Larry was mentioning a moment ago, there's also a political responsibility question here, because ultimately it really is the responsibility of the Congress to make these choices.
And that's the issue we're going to take up next with this roundtable. Really, what are the political issues? What is fiscal stimulus supposed to look like? Bearing in mind, we just heard part of the plan for the economy from Joe Biden this week. So that's coming up next with our roundtable with Larry Summers and Dan Tarullo. This is Wall Street Week on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Wall Street Week, and I'm David Weston. We are back now with our roundtable. Dan Tarullo, former Fed governor, and also Larry Summers, special contributor for Wall Street Week and former Treasury Secretary. So, Larry, we've been talking about the Fed. As you've suggested, there's a lot more to economic policy than that. But give us a sense, as somebody who's done this, who's really set economic policy, how do you set an economic policy given all the uncertainty we have of the pandemic, of what's going on with the recession, and even some of the racial injustice issues?
Well, look, I think during the Mexican crisis 25 years ago, President Zedillo said something that has always stuck with me. He said, markets tend to overreact, which is a reason why policy should overreact. And so I think the errors are much more likely to be of acting insufficiently boldly than they are of acting too boldly. I think we need a bold set of inclusive growth measures. This is not the time for thinking about and focusing on austerity. This is not the time for worrying about excesses of government activity. This is a time when we need to do much more. First, to put the public COVID crisis behind us. We need much larger investments in testing and contact tracing so we can perform like the European countries rather than the uniquely bad performance we're delivering. Second, we need to pivot to an aggressive government program that can absorb private savings, the excess of private savings and the consequent stagnation and low interest rates being our principal macroeconomic problem, and absorb it by doing things that are fundamentally socially important, putting people to work on repairing the nation's infrastructure, making our education system work effectively and be adequately resourced, channeling capital to the most depressed parts of our country. There's an idea that somehow we can't promote fairness without hurting business. And I think exactly the opposite is the case. And I think enlightened business leaders are increasingly recognizing that if we don't do some things to promote fairness in society, it's all going to come crashing down around them.
Well, Larry, let me put that question specifically to Dan. Is there a trade-off, or is it a misperception between increased economic fairness on the one hand and economic growth on the other?
Well, there doesn't seem to be any reason why there needs to be such a trade-off. I mean, after all, to the degree that one increases sustained aggregate demand of the sort that you get when people have money to spend, that should be good for business. And with the reduced share that labor has had of the nation's product in the last couple of decades, obviously you don't have that kind of spending. So there may be, and I think there is perhaps some conflict between taxation rates and more fairness. But I agree, there's no necessary trade-off between growth and fairness, and there's no reason why good progressive economic policy cannot take into account market considerations. There's no need to be a market fundamentalist.
I mean, let's be clear. The business community would have been thrilled 3 years ago if they had gotten the corporate rate down into the mid-high 20s. 21 was something that business community was not even asking for. Let's be clear. The best performance of the U.S. economy took, in terms of growth and per capita growth, took place in the 50s and 60s when top tax rates were much higher than they are now.
And that, and that is no doubt why Joe Biden is suggesting 28% instead. I want to thank our roundtable very much, Larry Summers and Dan Tarullo. Great to have you both back with us. We'll keep working on this roundtable. It's a work in progress, as it is for all of us working from home, but it's terrific to have the roundtable back up and going. Finally, one more thought. Back to school. It was the subject of much conversation this week, with President Trump insisting that the schools be up and running come September.
Very importantly, we're safely reopening our schools. We want the schools to be open and going in the fall.
While state and local officials struggle with exactly what that might mean, including the possibility of a hybrid of in-class and remote learning.
When we know that health and safety means social distancing, therefore we have to use a lot more space for fewer kids, it makes very clear the approach we will use is blended learning.
But the Trump administration doesn't like to do things halfway, so it surprised everyone this week when it announced that remote learning isn't good enough, at least when it comes to college and graduate students, and at least where those students come from overseas, leaving thousands of those students to wonder whether they can get the visas they need to continue their education in this country, and leaving the rest of us to wonder why, if it isn't good enough for students from abroad, it is good enough for American school children. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Airbnb was sailing on top of the travel world, expanding from a global home-sharing juggernaut into experiences, hotels, and transportation, on the verge of filing paperwork to go public in what was expected to be the biggest stock listing of the year. Then came COVID-19, and travel came to a standstill. Airbnb had $1 billion in cancellations almost immediately. Then came angry hosts.
We are collectively outraged.
Layoffs, and the economy went into recession. With no end to the pandemic in sight and only uncertainty ahead, travelers are slowly starting to venture out once again. But the captain of the Airbnb ship says travel will never be the same.
Joining me today on Bloomberg Studio 1.0, Airbnb CEO and co-founder Brian Chesky. Brian, thank you so much for joining us.
Well, thank you for having me on, Emily.
I'd like to start by rewinding a little bit. Despite what was happening in China, the force with which the pandemic hit took so many of us, so many businesses by surprise. Take me back to the moment when you realized that this was going to massively disrupt your business and change the course of Airbnb's history.
We have a pretty good-sized business in China, so we got some early indicators in January that something was happening. But I don't think any of us could have imagined that what was going to happen in China was going to spread and was essentially going to lead to an entire global shutdown. Late February, things started looking concerning. Our growth basically went to flat or below previous year's levels. And we were preparing for a crisis like 9/11 or 2008. We said, you know, this stuff happens every once in a while. You need to be prepared. But none of us were prepared for really a once-in-a-century crisis. Our industry, travel, has described COVID as big as 9/11 and 2008 many times over, something more akin to World War II. And when that happened, it felt like I was working on our S1. We were going to file it March 31, and it felt like 12 years of success and, you know, had all these things and life was great. And suddenly, you build something in 12 weeks and you lose most of it in 4 weeks. I can't quite describe what that feels like. And it just felt like everything in the company broke. I felt like a captain of a ship and a torpedo just hit the side of the ship. We were the tip of the spear. We were felt immediately. 2.5 billion people were shut down. And this became an existential crisis. As an industry, we had to stare into the abyss, and we didn't know if and when it would recover.
Now, travel came basically to a standstill, and in many cases, people didn't want to travel or they couldn't travel legally. It was illegal to rent an Airbnb. What was the lowest point for you? The darkest hour?
There were so many dark hours. That's the old quote attributed to Winston Churchill: "If you're going through hell, just keep going." And man, I will tell you, the first dark moment was when we had about $1 billion of cancellations from guests. All of a sudden, we get a huge number of cancellations. We weren't prepared for them, and they're calling customer service. Well, customer service call centers are shut down. So now we have to handle a huge amount of volume of cancellations working from home. So anyone that wanted cancellation, we offered an extenuating circumstance policy. We refunded them. But then suddenly there was an uproar. Hosts were really upset. And over the last 10 years, we've had a pretty good relationship with hosts. And then suddenly there were viral videos of hosts being really upset with us. We took $250 million of our own money and we sent it to host. It was the most we could afford to do during our darkest financial hour. And we're just completely scrambling. And I think that at that moment, not even knowing if and when people would travel again, I mean, that was pretty ominous, pretty harrowing. And that's the moment, like, I think a leader has to step up.
You also had to cut 25% of the company, and you gave, an incredibly generous severance package. Your note to the team, I could feel the pain in there. Talk to me about going through that process, cutting 25% of your staff.
It was the saddest thing I've ever done in my life, at least professionally. And we weren't sure if we'd have to do a layoff, and we had to face the hard truth that travel, we did not know when it was going to return. And we knew that when travel returned, it would be different. It would never be the same. And it's been really hard. Having to say goodbye to 2,000 people was incredibly sad. And now every day I told our team, we come to work for them because I need to make sure that the work they created will not just disappear in vain, that we're going to carry it forward.
So let's talk about the future. You mentioned you don't think travel will ever be the same. What does travel look like?
I don't know for sure, but here's what I'll say. Travel will be back, but it will look different. For now, here's what's going to happen. People are starting to say they want to travel again. They don't want to cross borders. They don't want to go to dense urban cities. They don't want to wait in line, and they don't want to travel for business. What they want to do is they want to get in cars, and they want to drive not more than 200-300 miles and stay in a home with people they care about. People are going to rediscover small communities around them. That travel's not going away, but it's going to be balanced. So instead of just Paris, it's going to be Petaluma, it's going to be Pittsburgh, it's going to be small communities. People are going to get in their cars, they're going to discover these communities. It'll be more experiential, it'll be more authentic, more local.
That's right, Airbnb is a global company. What trends are you seeing in Europe, in Asia, versus the United States?
So United States has been very, very strong. We've seen a temporary recovery in the United States. Europe, most of Europe, we've seen a recovery, a temporary recovery, other than the United Kingdom. United Kingdom, I think, is still locked down until July 1. But France, Germany, Italy, Spain, you're seeing really strong growth. Latin America is not recovered, and Asia is starting to recover, but not yet recovered. So North America and Europe are extremely strong. Latin America, Asia, kind of a bit behind.
Now, given new waves of the virus, and you saying that Airbnb certainly isn't out of the woods yet, what are you most worried about? What is keeping you up at night?
Well, I mean, we're absolutely not out of the woods. There could be a second wave. It could be pent-up demand. And also, we have other issues, like we have so much more demand around than we thought, so now customer service wait times are long. So we have new issues. There's always a challenge. And so I ultimately think we need to be totally focused on serving our community, getting back to our roots, back to basics of belonging, connection, and rebuild our company. And if we can rebuild our company, then maybe we can hire some of the people back that we lost.
How much do you think getting back to normal depends on a vaccine, or even then, things are going to be different?
They're going to be different. Travel as you knew it is over. You're never, ever going to see it again. I'll just say that right there. And I think business travel is really, really going to be hit for a while. I think a lot of people are realizing they can do meetings on Zoom. They're rethinking a lot of the conventions and conferences. People are going to rediscover the outdoors. For example, there's 400 national parks in the country. Most Americans have never been to a national park. Most Americans don't even know they live within 200 miles of a national park. I think one prediction, national parks are going to be in. People are going to travel a lot more outdoors. These are things that are going to happen. And the other thing that I think is going to happen is travel and living are going to blend together. What do I mean? Well, if you can do your job from home, then if you can work from home, you could theoretically work from any home, anywhere in the world, so long as you're in the right time zone. And so what you're going to start to see is not just travel redistribution, but you might see, and no one can say for sure, population redistribution. People may start moving to smaller towns and communities, or they may say, I'm going to live a few months here, a few months there. Why couldn't you if you can do your job behind your computer? And so we're going to start to see a real fundamental rethinking of travel and probably even urban living. And I can't say how it's going to play out for sure, but these are some trends that seem pretty obvious to me.
Meantime, in the midst of a pandemic, you've launched online experiences so you can get an Olympic athlete lesson. You can participate in virtual Pride festivities. How popular have these experiences been, and how big could this be in terms of being part of your business going forward?
I think that experiences could be as big or probably bigger than our homes business in the long run. It's going to take a lot longer, but it's possibly a bigger idea. The biggest asset in your life is not your home, it's your time. And just like COVID is going to, like restaurants are shut down, sports are shut down, we're going to see is a whole new era of entertainment. And I don't think it's not just going to be streaming. People are going to want interactive experiences with one another. And if all recent surveys suggest humans are more lonely than they've ever been in the longest of time. Instead of just going to a restaurant or watching something at home on Netflix, maybe there's a third thing you can do. And if you don't want to leave your home, you can actually have an experience, or you can do the same thing with a baker or an artist, some creative person. And so I think it's going to take a long time. I don't know how big online experiences will be. It is our fastest growing product. It's done about $1 million in bookings so far with only 400 experiences. So you can give that a sense of proportion. But I think in the long run, the overall category, it's going to be a really, really big category. It's going to take decades to play out, though.
So given that you've made this investment, you've scaled back on hotels, transportation, and some of these other things that you were pursuing, how does that change Airbnb's overall wider strategy? Like, what is your vision for Airbnb now? I think it's not much about travel. We have travel, but it's about belonging, connection. It's about hosting. So we're really focused on the business of hosting. Regular people that want to offer experiences, they want to offer homes. And I think down the road, they can offer many more things. So I think you'll probably see Airbnb even go beyond travel. For example, nearly 20% of our nights booked are for people staying in homes longer than 30 days. And as I said before, because of like working from home, people now will want extended living. What we sell is connection. And when it works out, you might feel like you belong in the community you visit. That's what it is. It's much more focused, much more about where it came from. And we're going to expand from there. When we go public, I think it will be successful. And I think that people will be really happy. And I do think we'll be public sooner than later.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
Airbnb was going to go public this year. You had the S1 ready. It was going to be potentially the biggest stock listing of the year. You haven't ruled out going public this year. Where are you with that?
We were ready to file March 31, so we'll be ready to file again. And the real question is, when's the world ready for us? And are they ready for us this year? Are they ready for us next year? Hard to say. I will say that we're recovering faster than we thought, but I also don't want to have false hope. You know, hope for the best, plan for the worst. The market seems like it's recovering, but again, there could be a double dip. So we're going to kind of play it by ear. I want a little more data. We're still a little early in this crisis for me to feel clear enough about how this is going to play out. So we're not rolling it out this year, but we're definitely not committing to a timeline right now.
So how likely is it that it would happen this year? And how do you weigh those uncertainties?
I wouldn't want to speculate or give a percentage. So I can just say it's on the table, but we're definitely not committing to it. The fundamental questions are, does travel continue to recover? Number two, is it a sustainable recovery or is it just pent-up demand? Number three, does the market have an appetite for companies listing that lost a bit of appetite after the IPOs last year, and then WeWork, like people kind of lost appetite a little bit. It seems like appetite's coming back. These are really fundamental questions, and if those things start to align, you start opening up a bit of a window. The other thing I just point out is there does seem to be an acceleration of adoption for Airbnb right now. So this is an opportunity for us, and it's probably just because it's like what people are just going with what the available options are. A lot of hotels aren't open yet. So we also don't know how sustainable the recovery is. Is it a temporary mix shift or not? So these are things that we're going to be following.
Now, the timing of Airbnb going public means a lot to employees who made a bet on Airbnb's future for their future. And I'm wondering if you've thought through this, why aren't you already public? Should you have gone out earlier? Was that a mistake?
I think we're going to look back on this period, and when we go public, I think it will be successful. And I think that people will be really happy. And I do think we'll be public sooner than later. I just don't know what sooner means. But I mean, I actually think we'll look back at it and hopefully it will play out well. I mean, I just want you to know, we have a real responsibility to our stakeholders. It means a lot to me that employees have a significant part of their net worth in our stock, that we have shareholders who have held the stock for nearly a decade. And so it's really important to me that they get liquidity. But I also think that, we're going to have a really great year ahead of us. So I think things could work out for people.
I wonder if Airbnb expanded too much, too far, too fast. And if hindsight's 2020 now, I know nobody was prepared for a pandemic, but do you think that was a miscalculation?
I think that we were a little unfocused and we strayed from our roots and we strayed from connection, belonging, and hosting. And we were pursuing a lot of things. These were worthy things. Somebody once told me you can do everything you want in life, not at the same time. Well, when you get really successful, you tend to think you can do everything at the same time. And I think that's a really big mistake that a lot of founders made. And I tried to do probably too many things at once. It wasn't as clear until COVID happened and we had the discipline. And I'll give you an example. Our US business, we had the same volume business as last year, but we cut a run rate of nearly $1 billion of marketing. We are not doing any paid advertising, online marketing at all. It doesn't mean it wasn't effective, we shouldn't have done it, but it really makes you rethink how much do you need to do and can we be more scrappy? So the company, I think, was inherently probably more profitable than we thought it was, because you don't really ever know until you stop doing everything. And then you start to see what you really need and what is essential. So it was this moment where you get to look at it with clear eyes. And I think we all looked at it with fresh eyes and realized we need to be leaner, we need to get back to our basics, and we need to be focused. And then hopefully that more focused company will grow even faster. And then we can launch new things. And then we can scale, expand, be big again, but in a more focused way. And then hopefully hire the people back that we lost. We're committed to remaining in China, and it's just going to be a different pace than it was before.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Protests have been happening around the world in support of the Black Lives Matter movement. You have made new commitments, set new goals for Airbnb. That 20% of your board and executive team will be people of color by the end of next year. Your teams are being given recruitment and retention goals that they have to meet by 2025. This sounds like quotas, which have been controversial because the critics would say this is forcing people to hire people they wouldn't hire otherwise. Why do you feel like this is the best way to achieve what you want to achieve?
Well, I mean, there's many things we're doing. We're not just identifying targets, but I mean, I think diversity doesn't just happen. It's got to be intentional. Diversity does not come to you. The world's not going to come to you. You want to make a more just, equitable world. You don't just wish for it. You got to work towards it. And you got to sometimes do things that are a little unpopular and you need to press against it. We can either choose to be a mirror to the society that exists, or we can choose a different path to lead our way forward. I think that starts with looking in the mirror and saying we're not where we need to be and being honest about that and saying, okay, we're going to do a lot of work to get there. And so I'm not apologetic. I'm not going to apologize about trying to step into the future, even if it's going to be really hard. And I'll just tell you one other story. In 2016, there was a hashtag that was trended on Twitter. It was called #AirbnbWhileBlack. And it was Black guests, especially in the United States, describing being discriminated against when they were trying to book a home. Now, I will tell you, as one of 3 white founders in their mid-20s to start Airbnb, it did not occur to me at the time, I was naive, that our product would be used in that way. Had I grew up in other circumstances, then I might have thought that. So this was a wake-up call. And so we've been working for the last 4 years. And over the last 2 years, we've been working with Color of Change, leading civil rights groups and privacy groups. And we have this vision. We don't just want to measure anecdotes, complaints of discrimination. We want to measure systemic bias and discrimination on our platform. To my knowledge, no internet company has ever tried to measure bias and discrimination on their platform through broad collection of data.
What is the data? Is this still happening, and how much?
It was a very low bar. We asked everyone on Airbnb to attest that they will not discriminate other people on the basis of race, religion, orientation, gender. And you know what? 1.3 million people chose not to check that box and not to participate. And I think we're better off because they weren't really committed to what we're committed to. I think we're in the beginning of a journey. I hope you have me back on the show and I can tell you about the progress we've made. I do commit that we're going to publicly report our progress. And that, by the way, is some of the best ways to make progress when you know you're on the hook. And if you don't make progress, you have to tell the world. I'm not going to want to come back on your show and put out the data and say, Emily, I've made no progress. So that's some pretty good motivation. You know, we internet companies this is a watershed moment. And I think what's happening now is we're realizing we, the platforms, need to take more responsibility for the content that's created on our platforms. This is something that seems completely obvious. Now, the extent to you want to take that responsibility is going to vary by platform, but we better not think that it's up to government to decide what responsibility we should take, because by the time they enforce, the damage is going to be done. We have to be in partnership. And so I think that we need to lead the way. The best thing for shareholders are companies, I think, who have consumers believe they're doing the right thing. This is both, I think, the right thing to do, but I also think it's quite self-interest for shareholders to do this as well.
In New York, you just settled a major lawsuit with New York City and agreed to hand over personal data on hosts. This is one of your biggest domestic markets. It could cost you thousands of listings in the city. How will this experience in New York change your relationship with other cities and your strategy going forward?
Well, New York has been a 10-year-long debate, and it's been the biggest holdout of any city in the country. Almost every major city, we've come to agreement. We collect hotel tax, and we're one of the largest collectors of hotel tax in the world. New York has been a market we have not had resolution until now. I think what COVID did is it led to a big reset moment, kind of for everyone, right? Like everything kind of felt like it got reset a bit. And so suddenly I think we in cities took a fresh look at all this. And we've come to an agreement that I think was months in the making. It's going to lead to a smaller Airbnb for now in New York, but I think we can rebuild from that. And I think it's an outcome that we all feel like we can live with.
Meantime, it all comes back to China. You are one of the few U.S. tech companies that still has a physical footprint in China. Google, Facebook, Twitter have all left or given up. How important is China still to you, and how much of a setback is the pandemic to your ambitions there?
It doesn't change our ambitions. It does change the size of the business for now. China's hit very hard, and China has not recovered as much as other countries. And so our ambition's the same, that we want to help people connect in every country in the world. We don't want to cut out 1.4 billion people. I mean, that really wouldn't get you very far to bringing people together. But it has made us take a longer horizon because it's pretty, it's been definitely impacted. And, you know, we're going to be pacing ourselves.
So you're still committed to maintaining the business there, given the challenges and the risks?
Oh, yeah. Yeah, we're committed to remaining in China, and it's just going to be a different pace than it was before.
Given all of these changes, what you've experienced, a pandemic that has changed the course of history and your history, Airbnb is bound to be a different company than it was going to be otherwise. What does Airbnb look like to you a year from now and 5 years from now?
I think a year from now, people are going to look at Airbnb, and instead of seeing just real estate, they're going to see hosts. They're going to say Airbnb is not just a marketplace, Airbnb is a community. And what they sell aren't just ways to save money while you travel, what they're selling really is connection. Now, these can be words. They can sound like empty marketing. I want to acknowledge that. I got to prove that. I got to deliver on that. I probably don't even deserve to use those words, except you're asking about what I hope to be able to say. So I hope a year from now, I don't even have to say those words. I hope you say that about us because we've earned that. And in 5 years from now, I hope that we go so much further, that we've created millions of entrepreneurs. You know, more than half our entrepreneurs, by the way, are women. It's totally different than like other sharing economy companies that are dominated by men on the supply side. And I think we can provide economic opportunity for entrepreneurs all over the world, an entire creative class of people. I think we can help create educational experiences. I mean, a lot of travel is educational. I think we can transcend. And ultimately, I think if we're successful, I think that you're going to connect Airbnb to feeling like you're a little bit more connected to other people. I want it to be real connections, not just like digital connections.
All right, Brian Chesky, thank you for making the connection with us today. It's been great to have you here on the show.
does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Barry Diller has always been a maverick, and the pandemic is no exception.
My instinct is that as the virus and the threat of it recedes, which at some point it will, then I think that behavior returns to the norm. Why wouldn't it?
I'm Eric Schatzker. Welcome to my front row interview with the change agent behind Expedia, IAC, and Match Group, Barry Diller. Barry, you've had a few months to think about how the pandemic changes the ways we live, the ways we work. Does life go back to normal?
I don't know. You know, I must say, we're living in the eye of this. We've certainly lost all objectivity, as you do when you're in the middle of something. Hard to project. My instinct is that as the virus and the threat of it it recedes, which at some point it will, then I think that behavior returns to the norm. Why wouldn't it? Now, there are some things that we have learned. I think probably handshaking may be gone for a long period of time, and close hugging and things like that might too. Aspects of work, we've certainly learned about what we're doing, Zoom. We've certainly learned to work from home, so to speak. I do not, though, believe that there will be the most basic changes in the workplace. I think that workplace work is better. The serendipity of moving among people, the atmosphere of it, the lengths that companies have gone to make their offices, certainly in the last, 15 years, 20 years or so, just the organization of offices has gotten so much more sophisticated and thoughtful about social interchange. We just finished building, for our sins, a new campus in Seattle for 15,000 people that we spent over $1 billion. All of the thoughtfulness that went into that work environment in so many different areas, I think is very good for the work itself. So I'm encouraging our own people, both at IAC and Expedia, to plan on back to work in offices as a mandatory thing. Maybe we change the work week some. I've thought that the idea of a 4-day work week, or not a 4-day work week, but a 4-day in-office week and a 5th possibly working remote may make some sense, though many people have told me that doesn't really work that easily. But generally, I think that that certainly this concept of social distancing is crazy. I mean, it is necessary for the moment, but as a long-term thing, we're not going to reconfigure our offices for social distancing. We'll do what we think is wise and sensible for the health of our colleagues. But the very concept in urban centers that you're not kind of packed tight You see people, I mean, in any urban center, in the late afternoon, you see streets crowded with people. I think that's going to return.
So tell me, Barry, why are so many CEOs, and you talk to plenty of them, so taken with the idea that we can shrink our corporate footprint? We need less real estate. We don't have to travel for business as much. People can work from home, and cities are doomed. Why are they so taken with those ideas?
It's of the moment. You know, it's kind of the, you know, new ice cream flavor. I think conventions and people getting together in mass is going to return. Now, it won't return until it can return safely, but it will return. We cannot live in this moment where we project the future based upon present circumstance.
2019 was a record year for Expedia, $12 billion in revenue. Any idea when we go back to when Expedia gets back there based on the trajectory, assuming, of course, there's a vaccine at some point?
Yes, of course. Look, a month ago, we were at minus 95% of gross bookings, sales. We're now around 70%. Now, going from 95 to 70%, if you look at it, that's really lovely. As a progression.
You're still down 70.
But you're still down 70%. I think that, again, this is difficult to do. You certainly, and why I find comical reporting from the year 2020 for anybody about anything. It's one reason we abandoned guidance, because this year, the only thing worth anyone reporting is their liquidity. Other than that, who cares? It's really irrelevant. The question is when.
Right. Right.
I certainly think travel is going to get back, because if you're, you know, if there's life, there is travel. Corporate's going to lag further behind. But I think that the recovery beginning, which has already begun, will accelerate through the rest of the year, assuming no exogenous craziness. And in 21, we'll get back, I'm not saying we'll get back to 100%, but I think somewhere between a recovery of 50 to 75% is reasonable next year.
So 25% revenue or 50% revenue in 2021 means you have to operate, I presume, on a much smaller cost base. You guys were talking about taking out costs before the pandemic. I have to presume that that's a much bigger job now.
Yes, it is. That's reality.
And how do you do it? Right? You've got $6 billion a year in marketing spend. You've got 25,000 employees. Where do you what do you take out?
What we've really done is we've done basically two things. We first of all ensured ourselves that we had enough liquidity to last us to any of the most dire projections of how long travel would be affected. And the second thing we did is we thought, don't let the crisis go to waste. Let us now reorganize the company in all sorts of ways so that we come out of this a much stronger enterprise.
when everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, you know, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with LACWA.
One of the biggest debates, not just in this country, but around the world, is over how fast to reopen the economy. Barry, who in government do you think has found that perfect, if not perfect, the right balance of growth on the one hand and public safety on the other?
Well, certainly our national government has not. I'm sympathetic to people pushing and saying we've got to get back to work. I wish we had a national rulemaking that said, well, this is exactly how you will do it. Most likely it is the wearing of masks as a mandatory application whenever you're in situations with other people. But because that was not done, these reopenings have been bastardized, and I don't know that I wish I could tell you. The only solution I can think of, other than shutting down again, is to say, okay, it's a national law.
It's a tough time for America, Barry. If there isn't a vaccine in the near future and it isn't widely available, what happens in the next few months? How does it play out for this country?
Well, I'm always an optimist, and of course, I can't tell you if what you say, if the conditions continue, which is spikes that are unmanageable, we will have to shut down again. There'll be no choice but to do it. And as for the people who are most hurt by this, the government is going to have to support them, full stop. I mean, you do get into situations where it's better to get paid for unemployment than the job you had. That has to kind of reach an equilibrium. But in fact, there's no way around this. We cannot have economic collapse at the local level. We will continue to print money and give it to them. I presume we will.
Barry Sternlicht, the real estate investor, has a dark vision for the future of New York City. He told me all the wealthy people are going to leave because of tax rates and because of crime, and that property values will plummet. What do you think?
Well, I'm fond of Barry and he's smart. I think he's wrong. Well, I think that, look, I think New York has, at the top end, has been overbuilding for a few years. And that's an inevitable contraction. I think that New York, yes, some wealthy people, by the way, not in the thousands and thousands, but yeah, some wealthy people are moving to Florida, where I think Mr. Sternlicht is, living a more pleasant, so to speak, life than in the big city, except that it depends upon your definition of pleasant. I've been a lot in the Southeast, Florida, and whatever, and they're very nice places. I've lived in Los Angeles off and on for most of my life, and it's very pleasant to live in Los Angeles. There is nothing like the heartbeat of New York City.
So you're coming back.
There is
you're going to live here.
There's nothing like it for ambition. There's nothing like it for stimulus. There's nothing like it for just pure vibrancy. Enormous numbers of people congregate in urban places, and there are very valid reasons for it that are not going away.
Barry, the pandemic has had the effect of making big tech so much bigger. You've competed with big tech for years. Is it time to start regulating Amazon, Facebook, Google, or perhaps even breaking those companies up?
Yeah, I'm not so sure I believe in breakup as an effective, as being effective. But I've been saying for many years now that regulation must come as these businesses grow ever larger, and I'm particularly thinking in this case about Google, but the others as well, as they become, Google is the only actual monopoly. The others have varying levels of competition, but they're absolutely, when you have monopoly power, you have to have regulation. And I think in the next couple of years, we'll probably get closer to it than we've ever been. I think that's healthy.
A growing number of companies are boycotting ad spending on Facebook over that company's policies on hate speech. Is that the right thing to do? Are you doing the same thing?
No. No, we're not. Look, we're not going to obviously support what we think is hate speech, and we're pretty careful about that. I've been I'm very much a supporter of Mark Zuckerberg. I think he's obviously brilliant, but also I think he's completely decent. I thought that his policy of saying, I'm not going to regulate essentially political advertising was wise, because I think it's almost impossible to try and regulate what people say politically, either for or against something. And I'm speaking of the candidates themselves and the apparatus around them and all of that. I just think that's sliding into a bad business. So, however, when there is identified hate speech, and I think they are addressing it. Of course, you're going to try and not promulgate that using the tools that you can use. I don't believe in boycotts. I think a quote boycott against Facebook is ill-advised and ill-considered. And you know, I'm hopeful. I think that Facebook is addressing the extreme forms of speech. But the truth is that, and you find it in any group of people, more than two, which is you're going to have opinion. When people have can have voice to their opinion and are amplified by our internet communications miasma throughout the world, you're going to get a lot. I mean, go on Slack or go on any channel of your own colleagues, give them anonymous voice. They're going to say terrible things about you. Not all of them, but some of them will. Get used to it.
Barry, Dara Khosrowshahi was your CEO at Expedia for many years. Why do you think he struggled at Uber?
My God, how could he not struggle at Uber? Give that little operation to anybody at the time he got it. I think he's done a fantastic job. Dara came in and changed the culture of that company with great speed and determination. He was on his way towards profitability. He was, I think, going to break even in the fourth quarter, which was a tremendous achievement. I don't know, the struggle of Uber has been a struggle of resurrection from what is a fantastic base business. They built up under Dara, they built up their Uber Eats business, which is a leader and will be a leader in the future. So good marks for Mr. Khosrowshahi. I mean, don't judge him on the market, on taking a company public and having it get, crashed because of all sorts of other things. Just judge him on the enduring value of the company he's building.
You once told me you'd never sold a share except to pay taxes. And I presume, given what I've seen, that's still true. And you're nodding your head, so I take it is. Barry, Bloomberg estimates your wealth at something north of $5 billion. What's the long-term plan for that money?
Topic of conversation within my family. It's in several parts. It certainly is in philanthropy. I have not ever agreed with people I greatly respect, Mr. Buffett and Mr. Gates, that you should not pass on wealth because it has deleterious effects on all sorts of things in ambition. I have another standard, which is you really should understand the character of those you are bequeathing wealth to. And if you feel they are of good character and responsible, then I have not only know, I feel there's nothing wrong and there's some right in passing on wealth. I don't think, again, if you know who you're giving it to and what their character is, you can make judgments. I do not think the giving or not giving of wealth has anything particularly to do, again, to the individual with ambition. And there are examples all over the place, good and bad in this. But I think you have a responsibility, as our family has, for certainly giving over half of our wealth philanthropically. And it gets complicated when you're dealing with the unborn, which in today's world, when you deal with these matters, actually you're kind of forced to do. It's not without its complications, but that's the best answer I can give you.
Barry, you told me in 2017 about meeting Mike Pompeo, who was then director of the CIA at the Allen and Company conference in Sun Valley. And at the time you said Pompeo's decency and his grasp of issues made you feel better about the Trump administration. In fact, the words you used were you felt you were in good hands. We've got a few months left of the Trump administration, at least into the election, and then we'll see what happens. How do you feel right now?
I've been disappointed. Listen, I can't help but be disappointed by anybody in this administration other than the Treasury Secretary, who I think has done a very, very good job. And I'm sure there are other people who've done some good work. But this is a terrible administration. And I suspect the closer you are to the president, the more harshly, again, with the exception to at least my knowledge of Mnuchin, the more harshly you should be judged. And I'm just hopeful that my worry is, I think if the election were held today, according to the polls, et cetera, I think we would have a change. I'm frightened that something will come between now and November that might change that. Nothing could be more important than changing this administration.
Why?
Because how do I do this quickly? Because it is rotten at the top. And I can't go much on with, if you don't know that, you're not sentient. So what is the point of saying it? It is rotten at the top. And when you have a situation like that, you know, we've had good presidents, bad presidents. We never had a rotten president. We now have one, and he should be gone.
Well, we have between now and November to see how it plays out. Barry, I want to thank you very much for taking this time to talk to me.
Nice to be with you.
That wraps up my exclusive front row interview with Barry Diller. Stay tuned to Bloomberg Television and Bloomberg Radio, and visit Bloomberg.com for all the latest news and analysis 24 hours a day. Stay safe, everyone. I'm Eric Schatzker. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Watching the best of Bloomberg Daybreak Middle East, the major stories driving the headlines this week. The Saudi central bank governor says he sees light at the end of the tunnel for the economy as consumer spending begins to pick up. Here our exclusive interview with Ahmed Al-Khalifi. Meanwhile, the CEO of SABIC says that recovery from the coronavirus pandemic may not come until 2022. We speak exclusively to Yusuf Al-Benyan. And tourists begin arriving in Dubai as the Emirate tries to revive a sector with crucial impact for the economy. We speak to the Director General of Dubai's Department of Tourism and Commerce Marketing. First up, the Saudi central bank governor says he sees light at the end of the tunnel for the economy as consumer spending picks up, although there is still a need to remain vigilant. Ahmed Al-Khalifi spoke exclusively to my colleague Yusuf Gamal Al-Din about his outlook for Saudi's recovery.
I think it's too early to say a V-shape because barring any downside risks that coming from the second wave of the virus, for example, or more negative developments in the global economy, we remain, we see light at the end of the tunnel, yet we remain vigilant, to be honest.
Governor, I mean, since the coronavirus hit, you've stepped in with all kinds of liquidity support programs. Some of them are due to expire in September. What happens then? Do they get extended?
Well, we have a program of support that has three elements. The first one was targeting the SMEs, the deferral payments or the funding for lending with 95% guarantee and affordable cost, and also the guarantees paid on behalf of the SMEs to the Kafala program, where we guarantee, we pay the fees for them. The earlier program, particularly the deferral of payments, was very successful, with a 70% increase on the assigned amount. And the second one was the injection, the pure injection of liquidity of also 50 billion Saudi riyal, which came later on, right after opening the economy in June 1st. The aim was to enhance the banking liquidity and enable the banks to lend more. And this has given banks more room in terms of liquidity. And the third one was the open market operation, which was commenced at the end of June, where we did not see really a strong appetite coming from the bank, given that we still have plenty of liquidity. So back to your question, whether we might extend or not, this we are still reading all the indicators, but this will depend on the real sector when it comes to the first program particularly.
Last time you didn't really take a view, and then we had the NCB Samba deal, right, to the tune of about $16 billion. Are you at this point encouraging more M&A in this sector?
You don't want to put it like you say encourage, but we here in SAMA, we see the M&A as a signal of dynamism in the financial sector. As a regulator, we don't see harm if the two institutions find themselves, they have the desire to merge, and they find themselves that they can add value to the sector, and we agree with that, and they add value to the economy, and that's what we saw in both mergers. The first merger, which did not take place, we agreed when they showed intention to merge, and we agreed when they showed intention to separate and end the deal. This time also we agreed when they showed intention to merge. And let's remember that still this is in the initial stage, and they are still in the process of the merger and acquisition, and it will be subject, by the way, to the approval of all the regulators, including the General Authority for Competition.
Governor, the Saudi foreign currency reserves have been front and center of much of our coverage in terms of understanding the impact of both the coronavirus and the lower oil prices. We're still at the lowest level since 2011. What is a recovery on that front likely to look like as you look to the second half of 2020 and into 2021?
Well, the level is still comfortable as we see it right now, $450 billion US, with around 40 months of coverage of imports of goods and about 80% of the broad stock of money. We did not see significant changes at the end of this month with the preliminary data. Our readings, of course, what impacted this was the transfer of the 40 billion Saudi riyal to the PIF, which was a strong hit, a one-off transfer, but it was a strong hit. What will support our reserve, as you can tell, is if there is more positive signals coming from the oil market, which we see them right now.
Meanwhile, the CEO of SABIC says the recovery from the coronavirus pandemic may not come through until 2022. But speaking to me in an exclusive interview, Yusuf Al-Benyan said that his company has a strong balance sheet and can cope with the current challenges to the global economy.
The G20 leaders, especially the finance ministers and central banks, they have been extremely proactively coming with a stimulus package that is really to support the economy. But I would like to highlight very important elements. I think we should not load all the challenges in the global economy in the pandemic. We have started experience some slowdown on the fourth quarter 2019. And I think the pandemic has just accelerated the slowdown in the global economy, and it created a sudden shock to the system. But we have seen a very good positive response from the regulators and the G20 leaders, specifically the finance ministers and central banks, where they have learned from the previous crisis, where they took their time to come up with a stimulus package. But this time the issue is not only the stimulus package. The issue, I think, we need to look at certain fundamentals of the global economy that enable us to look at structural changes related to digitizations, related to our ability to have a free trade. And more importantly, also, we should not lose sight from a very key principles, sustainability, and also people developments and human capital developments. I think it's very important that we don't lose sight of them, because normally through crisis, people forget about those long-term issues, and including, of course, integrity and compliance, which is very important for our B20. We have really dedicated a special task force to address compliance and integrity.
Yusuf, can I ask you to put on your other hat for a moment? I mean, those are the global issues, but you are running probably one of the most preeminent touch pieces of the global economy in SABIC. You talk about that slowdown began before COVID. So give the world a sense of what kind of recovery you are seeing in terms of demand and the shape of recovery that's coming across your desk.
I mean, let me just start with the positive remarks. I mean, people are really talking about a second or probably a third wave of coronavirus. I think what we have seen, all governments have been able to lock down their system, not in order for them to see how this is going to really unfold, but also to build the capacity to deal with this current crisis. I think the entire world recognizes that they cannot lock down the economy. They need to go back into normality, and they have to build the resilience in their system and citizens to deal with such a pandemic. Therefore, I see, despite the fact of any second or third wave, which people are talking about, is not going to push the economy to a complete lockdown based on our previous month's experience. In terms of the outlook for the economy, I think if we need to look at a positive recovery that is beyond or basically reference to 2018, I think that will be on the first or second quarter of 2022. So we will have this year and next year a year of recovery, and that will be subject to different industry, different economy that will be well positioned to deal with those challenges.
Do you think from the business side, and this is specifically about SABIC, you had to deal with the crisis, you suspended new CapEx earlier this year. Is that going to be enough, or do you think you're going to have to do more given what you're seeing?
Well, I think it's we need to look at this beyond just the CapEx. I think we as a company, we have a duty to make sure that we have a very strong, reliable, safe assets to secure a safety for our people and also the society and community surrounding our assets. That's initial top priority for us. And then we go into a mode of understanding how can we protect SABIC balance sheets, credit rating, in addition to continue having a very clear support to our dividend policy. And that, of course, also needs to be driven with our growth strategy to come up with how we're going to manage our capital. I think what the entire economy is facing is require a discipline on how we're going to bridge from today until 2022. What I can assure you that SABIC has a very strong balance sheets, enable us to really cope with the current market challenges. And as you can see from our first half of this year, we have announced first half dividends of 1.5 SAR. And I think that's really clearly shows how resilient SABIC balance sheets and our ability to cope with this, with the current challenges.
Up next, the tourists begin arriving in Dubai as the Emirate tries to revive a sector that is crucial to the economy. We speak to the Director General of Dubai's Department of Tourism and Commerce Marketing. This is Bloomberg. Welcome back to the best of Daybreak Middle East. The tourists began arriving back in Dubai this week as the Emirate tries to revive a sector that is crucial to the economy. Visitors must take a COVID-19 test before their flight and show the airline a negative result. Otherwise, they will be tested on arrival and required to isolate while they await the results. Meanwhile, these measures instill a sense of safety to discourage people from coming. That's the question. We spoke to the Director General of the Department of Tourism and Commerce Marketing, Hilal Al-Mari.
When we think about outlooks and expectations, right now we're looking at it in sort of two senses. The first of all, definitely tourism globally has been affected. And as you know, the UNWTO has talked about $1.2 to $3.3 trillion may be the impact on tourism revenues. We've gone through this pause phase where we've, the whole world has been paused. And now, we're seeing a gradual opening up of the markets. And, we're looking forward to seeing aggressive growth coming, once things normalize towards the year end. It's been definitely a roller coaster over the last 10 weeks. We're definitely in a much better place today. People are much more optimistic, and we're seeing it as definitely something very positive. Another thing, that I have to mention is, as with the public markets, people are looking through this pandemic. Definitely, as countries get things under control, as things normalize, we definitely see the other side as being a very quick rebound to tourism.
Yeah. Helene, I mean, we are all about numbers at Bloomberg, and so what I want to try and do is get a bit of a bigger picture view from you. You said you would hope that there would be an aggressive return to growth, to the numbers. What is the kind of base case that you're looking at in terms of how many people are going to come to Dubai, say, in August, in September, or even as early as July?
Look, I think when you're looking at July and August, as I said, it really depends on the opening up. We're definitely in touch with all governments around the world. And as you know, some airports around the world are not open yet. If we take July, Emirates is, flying to 50 locations. We're definitely working very closely with them on the opening up. The 380s will be back in action by the middle of the month, flying to London and Paris. So you could see, the month of July and August are very important to us. And as we build that network globally, we definitely are looking to see good growth. Now, post the summer, assuming things go well this quarter and the opening up happens and the rest of the world, we got out the door pretty early and the rest of the world also opens up. We expect to see the last quarter of the year much improved.
Hello, what is the risk? We've got quarantines around the world. So if we want to travel, if we want tourists to come here, they have to quarantine at the moment when they return. When do you reasonably expect those quarantines, for example, in Europe and the UK, to be lifted? Is that the alpha to scaling up?
Look, I think it's a very good question about Europe and the UK. It's definitely an evolving situation. As you know, these lists are getting updated every couple of weeks with these averages. And our government here is in discussion with the agencies and governments over there. And countries like us, who have definitely taken the WHO advice of test very seriously, seem to find themselves at a slight disadvantage in these early days because unless you're all looking at the same metrics, which is number of positive cases per test per 100,000, you can't see that as a challenge. Of course, keeping that in mind, Dubai has an extremely diversified market strategy, and as you mentioned, and when we're first opening up, as I mentioned, 50 markets is what we're immediately starting with. So we're not relying on any specific market or region. But you're right. I mean, we need to move past this phase, and we need to make sure that people can travel without quarantine.
Hilal, last time we spoke about how this might be an opportunity to bring in some new ideas, and the conversations that I've been having point to perhaps an experimentation with gambling. I want to know from you whether that's a conversation you're having or that you could be having in the near future.
I mean, that's one we've heard from Bloomberg several times, but I have to say it's the only place I've heard it. It's not something we're considering, and it's definitely not something on the radar.
Okay, well that's Yusuf's dream. You've just busted Yusuf's dream.
I'm sorry. Yusuf,
in terms of, it's okay. He'll get over it.
How did I turn into a gambler? I don't gamble, by the way. Just FYI.
He's the fast and Halal. He's the fast and furious one on this show. Look, on a slightly more serious note, what do you think the businesses out there need to do to drive this forward as well? They've come under huge pressure. F&B, hotels. What more do you think you can do to help them in the first instance? Will we see another assistance from government?
Look, I think definitely. I mean, what you've seen so far in the overall tourism sector, because you're not just talking about specifically hotels and airlines. You've seen the government come in very strong. You've seen the government come in and not only give delays, rebates, and everything else, but also reduce government taxation. Also, if you take hotels as an example of this, many hotel groups, own multiple hotels. What they've done is they've streamlined. They've made sure that they, keep some hotels open whilst holding the others back for when tourists arrive. We've been in continuous dialogue with them, and the most important thing is the early opening, the rebuilding of revenues for SMEs. If you take malls, you take the water parks and everything else opening last month. That's been very, very important. And we envisage, as we move towards the year end and as the markets do open up, people are going to start recruiting again. People are going to start, really trying to drive that growth because that's what they're there for with their businesses.
Hilal, Dubai is known for very close coordination across the sectors and industries just to make the tourism experience as complete as possible. Beyond Dubai's borders, though, the alignment seems to be a little bit less intact, let me put it that way, because Abu Dhabi is on a bit of a different page in terms of how the reopening should work, and the other Emirates as well, potentially. How key is it that you all get on the same page so that you can extend an offering that even goes beyond Dubai?
Look, I mean, you have to note this. Obviously, this pandemic came to everyone as a surprise, right? We weren't ready for it, and everybody has managed to really make sure that they deal with it in their own way. If you take the UAE is a federal government. Dubai has put in the most stringent measures, as well as the rest of the UAE. We've already been awarded, Safe City stamp by the World Travel and Tourism Council, and I expect, as each emirate, takes its own precautionary measures, I expect over the course of this summer, tourists to be able to enjoy the whole UAE once more. The opening up is not happening over one day, as I mentioned. It's happening up over the course of a period of time, just how the closing happened as well.
Up next, stocks climbed despite another surge in infections over the 4th of July weekend. What's driving the rally? We discuss. This is Playback.
Experience may sort of revitalize some of my ability to reach younger audiences, inspire young girls and women to reach a little higher, be a little bolder, inspire young men to recognize that these are things people do, not only men or only women. Live on an ocean planet. More aspects of our life and well-being are determined by and set by and provided by the ocean than most of us think about. Every other breath you take, you can consider that as oxygen provided by plankton in the ocean. That's how critically dependent each and every one of us is on the ocean around us.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Welcome back to the best of Daybreak Middle East. The risk-on start to the week with stocks climbing on Monday morning, particularly in China, despite another surge in infections over the July 4th weekend. That is a tug-of-war between better-than-expected data and virus fears. It continued, and we got the perspective of Pierre Chartres, Fixed Income Investment Director at M&G Investments.
Our view is there are still good reasons to be a little bit cautious in the markets today. As you say, we don't think we are out of the woods just yet. As you pointed out, there's really a divergence between the numbers on the pandemic front and the numbers in the economy and the reopenings of the economy. So we think that the coronavirus is here to stay for at least the next few weeks and months. It's about living with the virus. It's about living in suboptimal growth environments. So we're a little bit more cautious than the tone this morning, for example.
This is the City Economic Surprise Index that we've added for additional perspective. And you can see this tug of war between the optimism and the concern over the surge in coronavirus infections. How do you place protections in your portfolio recommendations? How do you hedge here?
Yeah, so our view, so we manage quite a lot of flexible corporate bond strategies, for example, and a good way to position ourselves is, broadly speaking, to stay up in quality at this juncture. So maybe more large global investment grade companies, for example, within corporate bonds in sectors that are less affected by the virus. So that would be the core of the portfolio. But of course, because valuations are more expensive in these parts of the bond markets, you also do have to make a few more investments within high yield or within the more cyclical sectors. So we kind of like a barbell approach, so fully invested, but still having some dry powder today.
And part of the hedge narrative for you is the dollar, although you warn on the rate differential as the dissipating risk. So you want to be long dollar where? On an outright basket or against some core calls?
Yes, so the dollar has really been, with the yen, and then you pointed out just recently how they've been trading in a range, but the two safe haven assets for that probably with government bond yields haven't fallen so substantially, those two currencies still can provide a diversifier. So we actually think that the dollar and the yen present great opportunities in that respect. Within a global bond portfolio, they're probably a better hedge now than being long duration. And for some of our strategies that are currency hedged, even after hedging, U.S. credit, again, for example, U.S. BBB rated corporate bonds, even after hedging, usually, in our view, are quite attractive, even on a currency hedged basis.
We also had Christine Lagarde made some comments in the last few hours. She said the Eurozone faces about 2 years of downward pressure on prices. Let's take a quick listen.
Inflation dynamics will be impacted with disinflation to begin with, and then inflation that will occur, that we'll have to anticipate, that we'll have to measure, but it will most likely be based, if we have an increase in productivity, on an natural increase in interest rates.
So, Pierre, where do you stand in this inflation-deflation debate? And what are your thoughts on what you just heard?
I think it's pretty clear that we are at the moment in a strong disinflationary environment. Just because of how weak global demand is, and you have to put it into context. Even before the crisis, we had U.S. unemployment, for example, at 3.5% at the end of last year, and the Federal Reserve was still struggling to meet its inflation target.
Up next, the UAE restructures its government as it battles the coronavirus pandemic and the oil slump. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
welcome back to the best of Daybreak Middle East. The United Arab Emirates this week restructured its government, merging 50% of the federal agencies as the nation seeks to shore up its finances battered by coronavirus pandemic and the oil slump. The Ministry of Energy has combined with the Ministry of Infrastructure, and that will be headed by Sahil Al-Mazroui. Meanwhile, ADNOC boss Sultan Al-Jaber has been named as the Minister of Industry and Advanced Technology, as well as head of Emirates Development Bank. We got more on the implications and the latest on the UAE economy with Doug Bitcon, Head of Credit Strategies at Rasmala Investment Bank.
I think just in terms of the UAE PMI numbers, yes, there has been a rebound. It is above 50.4. And that is not surprising considering the reopening of the economy. I think, looking forward, there are a number of challenges, and one of the challenges is the employment numbers. We see the employment numbers continuing to deteriorate. Moving forward, this is going to impact on consumption within the economy. But for the time being, the UAE is a services economy. As you reopen, you would expect the PMI to rebound. We have already seen a very, very strong rebound, and especially in the fixed income markets in the UAE, in the prices. And from this point going forward, I think it really is how the economy reopened and whether it manages to continue to stay open without a spike in COVID cases.
Doug, good morning to you. It's Manus. You talk about the performance in the GCC in the first quarter, the bonds and the Sukuk market, the Omani and Bahrain ravaged underperformance, down 23% and 17%. Do you think that those markets are at or near the bottom, or what is it that drives a recovery in those particular bond markets?
Morning, Manus. I think what we saw in the first quarter was actually something that we didn't even see in the global financial crisis, was the sell-off, and it was indiscriminate. Obviously, the high beta credits of Bahrain and Oman got savagely hit, but they have rebounded. If we look at the performance in the second quarter, those were the outperformers in the second quarter. But what we did see during that sell-off was actually the lack of liquidity in the market on what was previously very, very liquid assets. We were seeing 10 points bid-offer spread, which was unprecedented even during the global financial crisis. There has been a readjustment, obviously, as the Fed stepped into the market, liquidity returned to the market, and we saw a stabilization. And therefore, we've seen a rebound, quite a strong rebound. There is liquidity in the market, and I think probably looking forward for the short term, there is a reach for yield, and that would play into the hands of the likes of Oman and Bahrain.
You look at other real estate players like Damac, for example, and you're saying, you know what, there's an opportunity there, but at the same time, the risk of moral hazard is also much higher.
Yeah, I think Damac is not really a moral hazard play, because we don't see the government stepping in and supporting Damac as a property developer. Damac has actually probably been one of the first property developers that recognized the challenges that was going on in the market, and we've seen them looking to strengthen their balance sheet and focus on cash preservation over the last couple of years. So they haven't invested in material amounts of land bank, and they have been reducing debt over the last couple of years. So if we look at what they've got in terms of cash on their balance sheet and money that's sitting in the escrow accounts, Damac we see as more performance risk. Can they deliver these developments to a customer? And that would automatically release money from the escrow accounts. So Damac has a history of delivering, and we think that they will continue to do that. So if we look at the Damac 22s versus the Damac 23s, relative value, we think that the Damac 23s is a relatively more attractive than the 22s. But we like that name, despite it being in an unloved sector.
Now, you also have a call on Dar Al Khan. You say they have a rather opaque business model, but an unblemished track record, and that is what draws you to I love you're very generous with the discussion there about the business model. I'd love to put my money into an opaque business, but you say it's an unblemished track record, and that's what draws you to the 2025s, which is 3-year paper, which seems to be the new narrative globally, doesn't it?
Yeah, look, we've been following Dialogue Khan. They first tapped the market in 2006, and since then there's been a number of ups and downs through the market. What they have done, we saw in 2012, they had a sukuk that was maturing. It was $1 billion, and that was just as we were coming out of the financial crisis, and they managed to monetize some of their substantial land bank. And we've seen this play out repeatedly in 2015, 2016. What actually Dialogue Khan came to the market in November last year, they raised $500 million, and then they surprised the market by tapping again in February 2020, which we thought was unnecessary considering the amount of liquidity that they had on their balance sheet. But what it has done is it really has left them in a very, very strong position in terms of liquidity. Just from that perspective, it's very difficult for a company to default when they got $1.3 billion sitting on their balance sheet.
Up next, the chairman of the Abu Dhabi Department of Economic Development says the COVID pandemic has clouded the outlook for both the medium and the long term, but he's optimistic about the recovery. Our exclusive interview, that's next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Welcome back to the Best of Daybreak Middle East. The chairman of Abu Dhabi Department of Economic Development says the COVID pandemic has clouded the economic outlook for both the medium and the long term. He's optimistic that the measures the UAE government has taken will help the nation emerge from the crisis. Mohammed Ali Al-Shawrafa spoke to Bloomberg's Zainab Fatah.
Obviously, the economic growth in 2020 is subject to a lot of uncertainties, not only in Abu Dhabi, but also worldwide due to the COVID-19 pandemic. The virus has brought major economic disruption and a lot of challenges and clouding the economic outlook in both medium and long-term aspects. But when you look at the global economy, we illustrate the size of the disruption through the different travel restrictions are hitting aviation, tourism. Social distancing is also expected to reduce a lot of the domestic consumptions in most countries. Obviously, the global slowdown and disruptions in the supply chains were heavily hit Domestic measures, on the other hand, contain rapid spread of the pandemic, obviously compounding with the different pricing of the oil prices and pushed a lot of markets to recessions. But on the local side, I think Abu Dhabi governments continue to provide a lot of reliefs to the people and business in the coronavirus crisis by initiating a lot of programs, reducing costs, easing investment laws, and reviewing regulations and stimulating the economy.
When do you expect Abu Dhabi to fully reopen? Because right now we see a cautious approach in Abu Dhabi continuing.
Well, I think Abu Dhabi have taken a cautious approach, you're right, and I think this is the right approach going forward. Everybody is in uncharted water. I think the improvements that happened within the healthcare sector in Abu Dhabi have helped a lot, to be honest with you, either from the testing facilities that Abu Dhabi have implemented, and this has helped a lot in giving us a positive and a clear hands-on reflection of what's happening from the virus in terms of the spread. But as you see, the numbers are extremely positive, as you see every day in Abu Dhabi in terms of the infections and the cure as well. And I think we're expecting to normalize also oil prices going forward and the domestic, global and domestic demand to improve.
So I wanted to ask you here, we've seen in the past few years a consolidation drive in Abu Dhabi, where we see the mergers between banks and companies and so on. Do we expect this to continue this year? And should we at all anticipate some kind of cross-emirate combination between companies in Dubai and Abu Dhabi?
Well, to be honest with you, mergers and acquisitions are not always a negative thing, regardless COVID is there or no, or any crisis. I think entities look at optimization, not only from reducing costs, but also increasing productivity. And I think productivity is an important factor to the economic development, not only in Abu Dhabi, but also in UAE in general. The different mergers that happened the last year and the year before, I think it's a testament of the market is growing. I think we need to be more focused on what we do. I believe it is a positive, and we will always support any mergers and acquisitions that actually gives the positive effect in our economic growth and the contribution to our non-oil GDP in Abu Dhabi.
So which companies do you think could be prime targets for a possible combination?
Well, I believe a lot of the private sector now are talking either from Abu Dhabi side or even federal side. I believe the consumer sector is something that it is very ripe, and in addition to technology development, I believe the space is open. We as a government, we will always support, provided it doesn't have any problems from a competition point of view, because we as a Department of Economic Development look also at the consumer protection and as a competition agency as well. If it will add value to the economy, we will support it.
We've seen Saudi Arabia go ahead and increase VAT from 5% to 15%. Now the UAE came out and said that they don't plan any new changes right now. But should we expect further or increased taxation at some point in the UAE? Is that something being studied?
I think the current system in place, either in the federal or the local, is intact. There are no studies being developed now looking at different fees or taxation. On the contrary, we are actually looking at reducing a number of fees and aligning them with the international standards to be more easy, business friendly, and to attract and be more competitive from Abu Dhabi point of view, rather than making it an area which is only looking at revenue.
So can you tell us a little bit what fees are you targeting, or a little bit of details on this?
Well, we've already mapped what are the fees that are being paid by the private sector and the companies and the corporations in Abu Dhabi. And we're looking at what are the plans going forward? What are the areas that Abu Dhabi is really going to focus on in terms of clusters and sectors? And we're actually looking at the 2025 and 2030 economic plans. If we are going to implement these plans, what is the advantage to the Abu Dhabi economy in terms of diversification. And this is probably one of the most important areas that we are looking at, reducing the contribution of our oil GDP in Abu Dhabi by diversifying into other areas and doubling down on sectors and clusters that we believe going forward is the area that Abu Dhabi needs to focus on. So this is in general what we are looking at. And obviously one of the most important things is the competitiveness. Being competitive is not only reducing fees, but being competitive is having the right livability aspect of people coming, living, educating, and actually retiring in Abu Dhabi. It's not only the nationals, but we're also looking how to attract high-skilled number of people in Abu Dhabi. And I think this is a testament that Abu Dhabi is still continuing and developing its economy going forward.
I got the reaction to that interview and discussed the outlook for the UAE with Mary Salem, Head of Institutions at Demand Securities.
It's weird how we all thought at some point that increasing costs and going for higher VAT is not going to be the solution. And this is actually being implemented, and we totally agree with that. Everyone has been hit throughout that pandemic, and the solution is to actually have some sort of equilibrium when it comes to consumers, suppliers, and even government rules and regulations. So in order to get over that whole phase and overcome the crisis that we've been through, we need to have some sort of realistic view towards the economy and a way to measure it in a proper way in order not to harm people or a certain category of people in order to come out with a solution that is beneficial to another category.
Mary.
So having an equal side of the whole equation is actually the solution. Yes.
Okay, I mean, let's dig into some of the individual, because your role is to take data, information, try and come up with trading strategies. We caught up with the head of tourism yesterday. He's expecting an aggressive bounce back. They extend the metro, so they think that that's going to help house prices and rental prices along the way. I look at what the UK did with their VAT for food and beverage, and they adjusted it. In other words, they did another salvo to try and help the tourist and eating out economy. Do we need some new initiative which helps that sector here? And how are you playing that sector?
Now, tourism is a major factor in the UAE and specifically in Dubai, and we all know that. Opening up for tourism and tourists is something that will help boost the economy and might not help recover, because it also brings in the risk of actually increasing cases and going through another wave of the outbreak of the virus. But eventually, with the proper precautionary measures kept in place, we will surely get over that. However, we need to also consider that going into that phase will have impact on many sectors in the country, and this will probably help in a way or another, but we also need to maintain that cautious level at all points in order not to get hit back.
Okay, the other main note that we've been covering, Simone mentioned it a little time ago, is on HSBC. They've got quite a draconian view in terms of the earnings per share for MENA banks to fall by 17% on the EPS. And they do differentiate. They talk about DIB and Doha Bank. They've been cut. GTB and UBA also cut on lower payout assumptions. But Abu Dhabi Commercial and Commercial International Bank of Egypt are a buy. But the tenor of this report is what I want to touch on, because you and I often talk about banks. And we joke a little bit and we say, oh, you know, banks are a buy. I mean, we need to be more judicious. Goldman Sachs has one buy in the region, Simone says, and it's Emirates MBD. Your view in terms of the compression on earnings and that buy from Goldman's?
Now, the thing with banks, we know that we've had several incidents specifically in the UAE. So at the moment, everyone is concerned about the earnings. They're all very cautious about their investments in banks. No one is expecting the same dividend yields or dividend payouts that the banks used to pay earlier. Some are discussing actually eliminating the payouts. Others are discussing reducing those. also with banks, I used to be extremely bullish, and you know that, Manus. But I do request from investors, and actually think it's the proper way to actually deal with the banking sector at the moment in a very cautious way, and actually look for the investments that are guaranteed or more or less secure. Now, with Goldman Sachs actually choosing one bank, which is Emirates MBD, now there's an in-depth research that probably Goldman Sachs has conducted. But given the pandemic and the situation that we've been through, we're not expecting very good results for the second quarter, especially that's the period when actually the whole hit was taken. So we will need to monitor closely in the coming few weeks and expect earnings that are not going to be very positive, but we look forward to the period that's coming after that if the cases and the second wave is not as harsh as the first one.
Up next, the S&P 500 enjoys the longest winning streak since December as investors continue to shrug off COVID cases. How much further can the rally really run? This is Bloomberg.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Let's get back to global markets. The U.S. stocks shrugged off the virus fears on Monday. The S&P 500 extending its winning streak to the longest since December, and the Nasdaq hit another record. However, U.S. infections are nearing the 3 million mark. Top disease expert Anthony Fauci warns the vaccine may not be the solution that we are all hoping for.
We have to assume that it's going to be finite. It's not going to be like a measles vaccine. So there's going to be follow-up in those cases to see if we might need a boost.
We got more with Brett McGonigal, Capital Link Chairman and CEO.
Well, it's very impressive. I'm very encouraged by the move in China overnight. Pretty big rally, just under 6%. And then with the move in the U.S. on the back of it this morning, seeing the FANG stocks lead the way again. I'm a little bit cautious of the U.S. rally. I think we're quite extended. You're seeing some euphoria here. The retail investors are chasing a lot of the mid-cap, low-cap names, micro-caps, which is a little bit symbolic of chasing a top. So as much as I don't like to see the extension of the FANG stocks, it's probably a little bit better to see those, the real names being taken up here rather than the speculative names. But as I said, the encouragement that I see is really the beginning part of what I think is going to be a really big rally in the Chinese market. I've called for this for quite a long time, and it seems like we've really made a huge stride overnight. I think the momentum will start to pick up and people will start chasing there as well.
Can you justify the differential in terms of the speed of the China market rallying at such an exponential rate relative to the US? Is the velocity in this rally justified?
Well, look, I think velocity is something that, we always try to figure out what it really means. What I think in the Chinese move that's really impressive is it's somewhat counterintuitive when people are looking at how Hong Kong plays into it. A lot of speculation around politically what's going on between the U.S. and China on the Hong Kong side. It looks like it's really almost a nationalistic tone that we're taking. I said earlier on Bloomberg News, it's like the Summer Olympics for stocks. Everyone's trying to do their best to outperform here. And in the China move, I think it's really lagged. I think if you look at it, maybe not correlated to the actual bottom to the top, but where we are in historics, we're 5 years away from the 2015 high. We still have quite a long way to go back to 5,100, whereas Nasdaq is setting new highs every day. That's the thing that's really encouraging to me is I think we've got a long way to go to get back to those levels. So I look at more from the distance to travel up rather than where we've come off the bottom.
Brett, the folks at BNP Paribas did an analysis of the impact of lower Treasury yields on the U.S. equity rally. And what they've concluded is that the drop in U.S. 10-year specifically since the start of the year has boosted the S&P 500 to the tune of about 25%. How much more of a foundation can the lower yields provide for the U.S. equity trade going forward for the second half of the year?
Well, look, I've often been trying to figure out how really the rationalization works here, because you've got zero or negative rates, around the world, and people are being forced into other asset classes, and I think that's what the BNP strategist is talking about. So very low yields in the U.S. is forcing people into the stock market, and people are chasing. I don't really know. I don't really think that continues in the U.S. I do think you see asset allocation away from U.S. dollar denominated and U.S. assets and U.S. stocks. And I think it broadens out into China, as I've said many times. What I do think is really going to be interesting to watch is when we get some sanity back in the market and actually fundamentals kick in and people look at yield. Yield is not going to be found around the globe in any market except the Chinese bond market. And I think that's where you get a huge asset allocation. So I don't think that phenomenon is enough to buoy stock to really put a huge underpin underneath the U.S. stocks. I do think we'll see asset allocation away from that, and I do think it will trickle into the Chinese bond market as well as the Chinese equity market.
Remember, you can catch Daybreak Middle East every Sunday to Thursday morning right here on Bloomberg Television. That's 8 a.m. Dubai time. Do join us then. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
So when did the brilliant idea come to you to set up a brokerage firm?
Brokerage was built upon how well companies could make money and not how customers really wanted to do business.
Your ads in your company for many, many years have featured your face.
My director of our advertising said, "Why don't we use your picture sometime?" I said, "Are you kidding me?" We tried one. The results were up by tenfold.
Do you have any stock tips for me? I'd look for a couple stock tips. Do you have any good ideas of what I could do with my money in the stock market?
How about an index fund?
Would you fix your tie, please?
Well, people wouldn't recognize me if my tie was fixed, but okay. Just leave it this way. All right. I don't consider myself a journalist, and nobody else would consider myself a journalist. I began to take on the life of being an interviewer, even though I have a day job running a private equity firm. How do you define leadership? What is it that makes somebody tick? We're here today with Chuck Schwab, who's one of the best-known figures in the American business world, certainly has been so over the last several decades because of his ubiquitous face and his ads, but also because of the great company he's built, which is one of the leading financial service companies in the United States. He's now just written a book called Invested by Charles Schwab, and we're going to talk about that and his life, which is quite incredible. But let me start by asking you about something you made news with just recently. Your company announced that you're not really just going to do discount brokerage, you're going to give away brokerage for free. In other words, if I want to buy some stock, I call up Schwab, I have an account, and I trade for free. How do you make money if I'm trading for free?
Well, David, first, thanks for having me on your show. I had the opportunity to know you for a while, so I feel very comfortable being here and letting you know all of my secrets.
All right, well, tell me the secret of how you make money when you're not charging anything.
Well, a long time ago, we started taking commissions down, and that's how we started the business, with lower prices along the way. And finally, we got down to $4.95. I said, we're so close to zero, let's go there. And I always had somewhat of a passion for what the success of Google has been. They made search free, and they do very well by offering free search.
Right.
Similar in our case, we think we will do very well offering our services free for transactions, and that's the commodity part of the business. The rest of us, we give people, if you need help and advice on different kinds of things, managed accounts, banking, all those kinds of things. But the fundamental service we want to provide is free.
Okay, so I shouldn't worry about Chuck Schwab and not making money because we're service away for free.
You should not worry about it.
Okay.
We actually are giving up about 4% of our revenue in that decision.
Okay. So for those who don't really follow this, you started as a discount broker where you were giving lower commissions than the standard rates were before. Today, you've become a conglomerate, in fact, in the financial services world. You have about $3.7 trillion of assets under management. So you make your money on other financial services, is that correct?
Correct. But you know, one of the things, we are a conglomerate. We're really not in the original sense. We only focus on what can we do for individual investors and advisors who have individual investors.
So when you started doing this more than 40 some years ago, did you ever envision that you would be in more than the discount brokerage business? Did you say I'm going to build a gigantic conglomerate or not?
I did not, David. I mean, certainly we had a very limited view of where we were at the time, but frankly, we thought the original business only had would help maybe 10 or 15% of the population. People who did their own research and only wanted to have a simple transaction. As we found out, there are many, many people who wanted to help and advice.
So let me ask you about something that some people say makes you so well known. It's that your ads in your company for many, many years have featured your face.
I started Charles Schwab & Company from the investor's point of view. I invite you to find out more about Schwab today.
Now, was that something you decided you wanted to do?
David, it started out, obviously, our company started with a shoestring. We didn't have much money. And I had a tough time raising money because Wall Street certainly didn't want to help me develop competition for them. So as a consequence, our ads were really teeny. When we first started the business in 1975, there'd be one column by 3 inches. Come and save 75% on your. So people kept coming into our company. And as we grew over the next couple of years, we had some profitability along the way. We were growing very nicely. Once we had a nice article written in the San Francisco Examiner about us, they used a picture of me leaning over, as you remember, the old Bunko Ramo machines. And there I was, and my director of our advertising said, "Why don't we use your picture sometime? It'll show there's real people here." I said, "Are you kidding me? What's my mother going to say? What's my father going to say? What's my wife going to say? And my friends? You some kind of egomaniac?" And I said, finally he convinced me after some conversation. He said, "Just try one." We tried one. The results were up by tenfold. Because I think people thought, there's a real person behind this business, and I can identify him. I can certainly look for him in the post office. He's up on the wall there. I don't want to do business with him. So I think that helped. And so, anyway, my friends got over it.
But when you go walk downtown in San Francisco or anywhere in the country, but certainly in San Francisco, can you walk without having people say, "There's Chuck Schwab," and come up and ask you for some stock advice or something?
Yes. Well, it happens on occasion, which I'm always honored to have that happen. But for the most part, people don't really recognize me in some sense. Maybe I part my hair differently.
So when you were starting the company in the early days, if somebody called up and said, "I want to buy 100 shares of IBM," you had a broker, he or she would write down 100 shares of IBM. They then do something to go to the stock exchange.
We teletype it to the exchange at that time. Everything's written, everything's then teletyped, et cetera, to the central place in New York. Execution, we reverse the whole thing, call the client back. You bought 100 shares of IBM at $50 a share. But of course, very early on, we were very early adopters of a lot of technology to make ourselves more efficient. We just had to do that. And fortunately, I was close to Silicon Valley. Many of my friends were people in the valley itself, and I was an early adopter. And so we were one of the very first ones to sort of adopt internet in 1995, I think it was.
Now, one of the ways you got customers from all over the country, you had something in your mind to do branch offices. Why did you want to have branch offices?
Well, we found out early on, very early on, that at that time, about 50 or 60% of our customers wanted to come into a branch and make sure that real people there were behind the counter, that they could see that. And so our numbers, once we opened an office in a location, our numbers went up substantially.
So you had better technology, perhaps. You spent more money on technology than others. You had your face, which everybody got to like, and you also had the branch offices. But there's one other thing that really made your company grow from reading your book, it seems to me, is that you decided to do more than discount brokerage. You came up initially with an idea of, in effect, having people buy mutual funds through your platform.
Yeah, that was a big innovation.
Can you explain how that works?
When I first started the business, mutual funds were sold by salesmen, obviously. Got big commission for doing it. Up to 9% of the money invested went to commissions, and the salesman got half of that, we'll say. I thought no-load funds with no commission was the best way for an investor to go about investing, which I used some of the early myself personally through my IRA account. I said, this is crazy. Why can't I offer this service to everybody, a no-load kind of transaction thing? So we went to the no-load companies. They're all small. So give us a little piece of your management fee, and we'll offer your fund for free to our whole network of Schwab clients. And clients loved it.
So you were the CEO from the beginning, and then eventually you had a co-CEO, and then the co-CEO had a heart problem, and he had to step back, and then you brought somebody else in, but you at one point kicked yourself upstairs a little bit, made yourself chairman.
I did.
And then somebody else was running the company, and then it didn't work out, so then you came back in for 3 years to run it again. Was that something you really wanted to do?
2004, I came back in. I wasn't sure I wanted to, but obviously I loved the company so much. Came back in 2008. I retired again as CEO. I had Walt Bettinger take over and done a fantastic job for the last 10 or 12 years.
Right.
And but I'm always sort of hanging around as the compass of the company. I keep pushing the people. We're going this way, it's north.
So when you graduated from Stanford Business School, did you say, I'm going to go join a private equity firm or a hedge fund?
As a kid, I wanted to find out how could I become successful. So I found financial services was a way to go.
This is Bloomberg Best, your weekly review